Here in New York City, I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance's flagship show, The Morning Brief, the ultimate guide to help investors make smarter decisions for their portfolio. We're tracking early session volume while bringing you today's top market themes and elevating Yahoo Finance's most popular newsletter.
That's right. We've got a packed Monday show for you today. Fed Chair Jerome Powell dashing hopes of a March rate cut. Once again, in his Sunday evening 60 Minutes interview, talking about balancing the risk of moving too quickly.
Moving too soon would set off inflation again.
You could, or you could just halt the progress. I think more likely, if you move too soon, you'd see inflation settling out somewhere well above our 2% target. If you move too late, then policy would be too tight, and that could easily weigh on economic activity and on the labor market.
And we'll hear commentary from a number of Fed officials. Among the list of Fed presidents speaking this week is Austin Goolsbee, Raphael Bostic, and Loretta Mester. Plus, we've got commentary from Susan Collins.
And as hope for an early rate cut fades, pressure is on earnings to keep the market's momentum going. So let's get right to it. The three things that you need to know on this Monday morning, your roadmap for the trading day. Yahoo Finance's reporters Josh Schaefer, Alexander Canal, and Jared Blickery have more.
Hey, Shauna, equity futures pulling back from record highs today after Federal Reserve Chair Jerome Powell sat down with television show 60 Minutes on Sunday night, reiterating the FOMC will move carefully with interest rate cuts and that Fed officials want to see more good data to prove inflation is moving in the right direction before cutting rates.
And McDonald's missing sales expectations as the conflict in the Middle East weighs on the burger chain's international traffic. McDonald's CEO acknowledging the challenged consumer environment in the earnings release, writing, quote, "We remain confident in the resilience of our business amid macro challenges that will persist in 2024.
And Boeing's woes, they continue. The aerospace giant found another issue in its 737 jets that could delay deliveries of about 50 aircrafts. The manufacturing problem originated in Boeing's fuselage supplier, that would be Spirit Aerosystems. Both stocks are falling in pre-market trading.
Well, our top story today, stock futures edging slightly lower after Fed Chair Jerome Powell says the time for rate cuts is coming, but the central bank needs to see more good data showing inflation moderating towards 2%. Powell making the comments on 60 Minutes Sunday night. It comes after the January Fed meeting where Powell poured cold water on the first rate cut coming in March. Only around 15% of traders are now pricing in that cut. And there you're taking a look at the CME Fed Watch probability. Josh Schaefer joins us now to talk through this a little bit more. Hey, Josh.
Brad, do you think he said that much different than what he said on Wednesday?
Not too much different.
I don't think he said too much different, right?
No.
I think there was one point in the interview that was interesting, and Goldman Sachs highlighted this. Jan Hatzius, his team, in their note today, essentially saying, well, 60 Minutes indicated that maybe off camera, Powell might have said, maybe we'll cut midway through the year, which if we're really extrapolating what midway through the year means, I don't even know. But that in theory could be June, it in theory could be later than June. But it was also interesting that they thought that in that they took out that the Fed could also cut 25 or maybe 50 basis points at a time, so perhaps steeper cuts. Mm-hmm. But the thing here, I still think the takeaway is when you look at, we just mentioned the March cuts, right? But look broader at the interest rate cut bets that we take a look at for the year. When you look at that graph and interest rate cuts for the overall year in 24, it hasn't changed that much. So when you look at that darker orange line, we're getting into the color thing here, Shauna, that we love to do. We'll go darker orange as the bottom and yellow as the middle, right? Darker orange was December when we really had the soft landing trade take off. Yellow is right after the Fed meeting. This is as of Friday. The picture of where we end this year hasn't changed that much, and that's been the big takeaway from most economists and strategists over the last couple of days. You can argue about March or May until your face turns blue, but if we're still going to get down to about 4% at the benchmark interest rate by the end of the year, that's what matters the most.
Yeah, exactly. And Josh, it's very similar to what we've heard from a number of economists, strategists, even on our program over the last several weeks, that there's way too much talk about the timing of that first cut. Obviously, we love to talk about it in the media, but really in terms of from a strategist perspective, it's all about the pace of the cuts and exactly what that rate is going to look like by the end of the year. But let's just focus on the short term, right? Because a lot of traders out there, a lot of our viewers are trying to figure out what the next couple of weeks are going to look like. How how much pressure is on these earnings reports to live up to expectations, to exceed expectations, given the fact that we might not be seeing a rate cut anytime soon?
No, you definitely puts more pressure on the fundamentals, right? Because that's really one of the only, I guess, quote unquote, positive parts that you could have in the overall story right now if you were someone that was betting on rate cuts to then increase earnings, coming out 3-4 quarters from now. Well, that's not coming necessarily right now. So you're looking at what's happening right now. We have seen a little bit of a turn here, guys. I mean, when we take a look broadly, I was sitting here a week ago and we were saying you kind of need big tech to turn the story around, right? We have overall S&P 500 earnings per share is negative right now. And then you look at what big tech did, we're positive again for the quarter. A lot of people made things about the Microsoft and Alphabet earnings. Obviously, the stocks didn't do that well, but it was interesting FactSet pointing out in their note, they still beat estimates. They still beat the high bar. It just didn't really work for investors based on where the stock price is. But what we're seeing in earnings right now has been pretty solid. Savita Subramanian, I'm looking at her note right now from this morning, highlighting a 6% beat, saying it's, quote, debunking the bears. And I think overall, you're seeing a decent narrative play out. Of course, not everyone has been a winner.
Debunking the bears. I like that. All right. Josh, thanks so much for teeing this up for us. And the conversation continues to move forward here. We were talking about earnings here. Let's talk a little bit more about McDonald's. The golden arches, whatever you want to call them down right now by about 1.4%. Share sliding this morning after global same-store sales rose 3.4% during the fourth quarter. That fell short of estimates, though. The fast food giant also facing setbacks from conflicts in the Middle East. Yahoo Finance's Alexandra Canal has the top takeaways here. Sorry, I was thinking about this company that's usually electric.
Usually it is.
Not so much today.
Not so much. Like you said, that surprise same-store sales miss dragging down the stock today. We also saw revenue come in lower than expected. We did see a beat on the bottom line, but it's that same-store sales miss that analysts and Wall Street investors are really going to be focused on here. Same-store sales, also known as comparable sales. It's one of the most important metrics for restaurants and fast food chains. McDonald's has consistently outperformed in that area, but we're seeing that miss in both the U.S. and international markets. So global same-store sales clocking in at 3.4%. That's lower than the expected 4.79% jump, while U.S. sales growth came in at 4.3%. That's just shy of the 4.45% increase Wall Street had expected. So still growing, just not at the rate that analysts were looking for. And a big reason for that stemmed from the conflicts that are going on right now in the Middle East. This is something that CEO Chris Kempczinski alluded to prior to the earnings report. He had a LinkedIn post back in early January saying, quote, several markets in the Middle East and some outside the region are experiencing a meaningful business impact due to the war and associated misinformation that is affecting brands like McDonald's. There's also been boycotts over the chain's perceived pro-Israel stance. The call is currently underway right now, so I'm sure the Middle East conflict, how McDonald's plans to handle this moving forward is going to be a big emphasis on the call here. But let's get to some good news, because McDonald's loyalty program still very strong, and a big reason why we saw that beat on the bottom line there. Loyalty members bringing in $6 billion in sales across 50 markets, more than $20 billion when you look at the whole fiscal 2023. That's a 45% jump compared to 2022. So loyalty remains strong. The consumer also apparently strong in the face of price hikes and those larger check sizes due to inflation. McDonald's saying that in that release, quote, we've remained confident in the resilience of our business amid macro challenges that will persist in 2024. So despite all of this, I think Wall Street is overall very bullish on McDonald's as a company. But again, we'll see how they handle this same-store sales miss, because it's not something we normally see from this company.
We don't normally see, and I think this might have taken the street maybe by surprise just a little bit, given the fact that McDonald's is one of these names that has been relatively resilient. When you talk about the fact that consumers are trading down, they're still going into McDonald's. I'm curious also, Ali, what the street's saying about some of the softness that maybe we could see looking out to the rest of 2024, right? If we're already seeing a little bit of weakness, a lot of that being driven by the Middle East, and we're not getting potentially that rate cut anytime soon, putting putting maybe more pressure on Americans, what that would mean for a name like McDonald's.
Yeah, we already saw McDonald's hike prices in 2023. It's very possible we could see those price increases increase this year, especially as you were saying, if we don't get that rate cut, if there's more pressure on these businesses. And the Middle East conflict, it's not going away anytime soon. And I think some of that pressure that we saw in the fourth quarter, it's likely going to continue in Q1, and hopefully we get some answers there. But I do think there are overarching risks here for the company. No pun intended.
Overarching risks for the golden arches, right, Allie? Thanks so much. Let's get to another top trending ticker here at Yahoo Finance, and that is Caterpillar. Shares on track to hit an all-time high in pre-market trading, or they're set to open at an all-time high here as we see this move higher in pre-market trading. The company beating the street's expectations here. Revenue $17.1 billion in its fourth quarter. Adjusted profit per share of $5.23. You're looking at gains here ahead of the open of about 4.5%. Digging into these numbers just a bit here, it's clear, my takeaway at least, Brad, is that demand has stayed relatively resilient, especially when you look at these North America numbers. Retail sales there up about 11%. They raised their margin target here by 100 basis points, also saying that they expect to reach that in the top half of the new range in 2024. Early street reaction looks to be pretty pleased with these results. TD Cowen calling it a strong quarter here for the company.
Yeah, favorable price realization is what the company brought up a couple times within this release. Now, take a look at this while we've got it up on the screen. The construction sales by region, and actually if you cascade even further down, you'll see some of the consolidated sales and revenues by region. North America really was the only bright spot on a regional basis. Everywhere else, you're looking at declines. However, one of the huge things that kind of jumped out to me as the company gives just like a little bit more of the details around this, North America specifically saw that favorable price realization that I was mentioning earlier, offset by lower sales volume. So that's interesting there. So despite that lower sales volume, which they're saying is kind of driven by some of the impact from dealer inventories, they also still did see higher sales of equipment to end users. So all this considered, dealer inventory did increase during the fourth quarter of 2022 compared with a decrease of the fourth quarter 2023. So improvement on inventory side, but at the end of the day, looking at Asia Pacific, lower sales volumes, decreased sales volume driven by the impact from changes in dealer inventories as well. You got to think about what the spending into certain construction projects as well within that region, especially as we've been monitoring the liquidation of one of the largest property developers within that region, how that cascades through to the number of projects that actually get greenlit to get started as of right now as well. And so that's something, of course, will be interesting to see if the company comments on it specifically in the earnings call.
Yeah, certainly. We're going to be talking to an analyst here later on in the hour, getting their perspective on what we're hearing from the conference call is taking place right now. All right, let's talk about another ticker here, and that is Boeing. The problems continuing here for the company, now finding misdrilled holes in some fuselages of its 737 MAX jets and causing some reworkings here to 50 planes that have not yet been delivered. Now, this latest setback for Boeing could cause a further delay in deliveries, which is one of the reasons why you're looking at a loss of about 3% here ahead of the open. It is just another issue, another challenge that Boeing and its leadership team and its employees are having to navigate up until this point here, Brad. We talk about the fact that they're still dealing with the fact that they're not able to expand production of the 737 MAX 9 because of the issues stemming from the door that was blown off mid-flight on the Alaskan Airlines flight several weeks ago. We've heard more and more commentary from Boeing's earnings release last week, also from a number of the leading airliners, just about how they're thinking about the latest developments out of Boeing, how they're navigating those challenges. But again, this issue only affecting so far 50 undelivered planes from what we are learning here from Boeing, but certainly a challenge here. That's just another setback for Boeing.
What's also interesting is what's coming about in some of the lawsuits as well, and the clarity, the detail that we're getting about what's taking place at Spirit Aerosystems, which is the company that is responsible for some of the process to build this plane, and at the end of the day is really the manufacturer or the supply chain part where the holes get drilled as well. And the fact that one of the employees who has since been let go, it sounds like as part of the lawsuit had offered some additional context and color about the operations internally, about these Pizza Fridays that were essentially driven by not having as many of the reported issues. So you think about days without incidents, days without a report, and what was driven by that at the end of the day, it sounds like they were incentivized to not report certain things. And if they did, then, they would have some type of retaliatory effort, which in itself is retaliation. And anybody who's going through an HR training course knows that you should not be let go for something like that, especially when it's within the realm of your job. All that aside, Spirit Aerosystems, they're set to report earnings later on this week, I believe tomorrow. So we'll see what they have to say about this on the call. They still have their statement up from earlier actually in January as well. Yeah. Coming up, everyone, Estée Lauder getting a big boost on the back of its results. We'll speak with an analyst from Canaccord Genuity on the other side of the break. Shares of Estée Lauder companies skyrocketing after the beauty brand announced a restructuring plan, reducing the company's workforce by 3 to 5%. The announcement coming in the company's second quarter earnings report, which showed a beat on the top and bottom line. Revenue coming in at $4.28 billion versus $4.23 billion that was estimated. This still represents a 7% decline from the prior year. Adjusted earnings per share in the second quarter, 88 cents versus the 55 cents that was estimated. For more on the results, let's turn to Susan Anderson, who is the Canaccord Genuity Managing Director. Susan, I mean, you look across several different elements of this report, and it wasn't a standout report, but it seems like the market is just saying better than expected, I guess. Relief that it's not as bad as it could have been.
I think it's better than feared. They beat on the bottom line, which was nice to see. They did, bring down the bottom line guide a little bit, but I think overall, investors may think that's conservative. So, it looks like while China is still not positive growth and travel retail is not positive growth, it does look like maybe on easy compares, but things are getting a little bit better there. They're starting to work through inventory in the travel retail channel. So I think, on low expectations, all of that was a positive.
Susan, when we come to, or I guess when we dig down into some of the weaker parts of this report, clearly it shows that consumers are under pressure. They're struggling in some of their key regions. Is that going to be a trend that you think is going to continue to weigh on the company, to weigh on sales here for the remainder of 2024?
Yeah, well, we have a hold rating on Estée Lauder, mainly, due to the issues in China, which we don't really see, improving much over the next couple quarters. So, that's mainly, I think, going to be dragging down the business as they continue to try and improve things in that region. But given the macro issues in China, we think it's still going to be tough for a while. In travel retail, just on easy compares, I think things could sequentially get better, but it's still pretty tough also in travel retail. So those are the main two issues. I think all the other regions are doing better. North America, they did note, though, was down mainly due to the department store channel. But beyond that, everything else did see positive growth.
So overall here, for investors that are trying to understand the strength of the little luxuries trade, how strong is that still? And according to Estee Lauder, but plus all of the other kind of top picks that you have in the industry?
Yeah, so we're still seeing strength in beauty, particularly prestige beauty continues to be very strong. Luxury beauty also continues to be strong. So, I think the difference between luxury beauty and maybe some other luxury items such as handbags is that you can buy a luxury beauty item or prestige item for a lot cheaper. So a lipstick for $50, $100. And typically, in weaker macro times, consumers look to beauty to make them feel better. So it does stand up well, even, if consumers are pinched elsewhere. So we expect that to continue this year. We're not expecting the strong double-digit growth we saw last year in prestige, but continued strength in beauty.
Susan, when it comes to some of the trends that we've been seeing with Estee Lauder, they're losing some market share to their rival L'Oreal. You have these up-and-coming brands like e.l.f. that are really connecting with a lot of the younger users, at least, and people are no longer buying Estee Lauder products and instead are buying some of those cheaper products. What is, or can Estee Lauder compete with some of these newer rivals that are out there? What do you think they need to do in order to win back that market share?
Yeah, so they do own The Ordinary, which still is very strong for them. It grew, one of the fastest growing brands that they have. And it's more in that, lower price point prestige category. And it really caters to that younger consumer. So I think things like that, where they can, maybe snap up some of these brands that are resonating very well with the younger consumer. And then also, I think they're doing a good job with MAC, kind of rolling out new products there, really staying on top of the trends. So brands that I think still can resonate with the younger consumer, such as MAC, I think they can really increase the innovation there to drive growth.
All right, Susan Anderson, great to get your thoughts here, your insight this morning. And Estee Lauder shares jumping in pre-market trading. Thanks, Susan.
Thanks.
All right, time for some trending tickers here. And we've got Novo Nordisk shares climbing higher after its parent company, Novo Holdings, inked a $16.5 billion deal to buy manufacturing giant Catalent. Now, Novo Nordisk purchasing 3 of the newly acquired U.S. plants for $11.5 billion to keep up with increasing demand for obesity drugs. So drilling down into what exactly this means for Novo Nordisk, which, to remind you, is Yahoo Finance's Company of the Year. This is all a play on meeting that demand for their weight loss drugs. But we've been talking about time and time again. Yes, we have seen a surge in demand, and as a result, we've seen a surge in the company's market cap and shares over the last several months. They're struggling to keep up with that demand. They're hoping that this newest transaction, I would say, would help them better do that. It is important to point out that this isn't going to have an immediate impact on the company. When it comes to increasing production manufacturing capacity, it's going to be a 2026 play and onward. But again, it shows the fact that Novo Nordisk is taking action, doing all it can to try and meet that demand, which has really propelled the stock over the last year. Yeah,
they actually acknowledge contingent on the timing of closing. So this acquisition actually could have a low single-digit negative impact on operating profit growth in both 2024 and 2025. But you mentioned it, and spot on. It is about this long-term growth trajectory that the company sees within some of the obesity and diabetes treatments as well, enabling some of the expansion and scaling up for that manufacturing capacity is what they're talking about. And it seems like this is really targeted on 3 sites that employ about 3,000 people. So we'll see how accretive this is able to become for the business long-term. And then additionally, where this essentially allows them to try and kind of stave off any other market competition that we know is revving up fast and furious.
It certainly is. And we heard from the CEO when he joined us after being named Yahoo Finance's Company of the Year that they're just scratching the surface when it comes to their role in the weight loss and demand in the community there for that drug. So we'll see what exactly future holds when they're making big bets like this in order to try and meet that demand. All right, well, coming up, we've got the opening bell on Wall Street. Again, you're looking at pressure across the board. All 3 of the major averages set to open the day lower. More on that when we come back. Let's take a look at our stock to watch, and that Goldman Sachs feeling bullish on NVIDIA, raising their price target on the stock to $800 a share from $625, reiterating their buy rating. Yahoo Finance's Madison Mills on the floor of the New York Stock Exchange with the details there. Maddie, we're looking at 3% move to the upside ahead of the open.
A huge upside for this name that's likely to hit another record as of the opening bell coming up at 9:30 here. And exactly like you said, Shauna, that is because of this giant upgrade to the semiconductor giant that is NVIDIA coming out from Goldman Sachs this morning, upping their price target to $800. That implies an over 20% gain from their previous price target for NVIDIA, which was at $625. I also want to point out the average analyst estimate for this name in terms of the price target, which was $679.64. So over $100 above that average analyst estimate. And if you take a look at the Yahoo Finance platform, you can see that NVIDIA is at the very top of its 52-week trading range. So that could be an indication of bullishness across our audience of retail investors on this name as well. We're also hearing bullishness from the likes of Stanley Druckenmiller saying that this is not only going to be a good play for this year, it's going to be a good play heading into 2025 and 2026 as well. So seeing a long-term story here. Now, why is that? That is because we had some questions about whether or not the data center demand was there for NVIDIA. And we've already gotten some clues in previous earnings that that demand story is stable, right? We heard obviously great earnings report from Meta on Friday, great earnings from Microsoft as well, two of the big customers for NVIDIA's data centers. So that is a bullish signal for NVIDIA. Also, it's continuing to be a bullish story across the chip sector. When you look at earnings from, I think about an IBM even, strong demand there is going to indicate strong demand for NVIDIA moving forward. And that is what they noted in this Goldman Sachs report, talking about positive earnings from SMCI as a bullish indicator for NVIDIA moving forward. The big final question I have is, what is the demand going to look like out of China? That made up about a fifth of NVIDIA's revenue in 2023. Are they going to be able to continue that? We'll find out more in their earnings print on the 21st.
All right, Maddie, thanks so much. Again, in just about 30 seconds here until the opening bell on the street. And Brad, this is going to be one to watch because we are set up for what is going to be a very busy week of earnings. It's going to give us a little bit of a better sense just at the health right now of corporate America.
Midpoint of the fourth quarter of earnings season, as FactSet says, and rightly points out here. Take a look at the opening bell on Wall Street. There at the NYSE, you've got, well, we had them up on the screen a moment ago. Let's go to the Nasdaq. You've got Cognite ringing the opening bell there. Hey, some funfetti on a Monday. Why not? There you see it up in the air. And now we've got the NYSE back up. Element Solutions, ticker symbol ESI. Fun bunch of folks up there. All right. Get it done. Let's go. Yahoo Finance's Maddie Mills is on the floor of the New York Stock Exchange. Jared Blickery is standing by at the Interactive after Fed Chair Jerome Powell's comments on 60 Minutes yesterday. Investors hoping of a March rate cut are nearly lost here. So, Maddie, how are the markets moving following that news?
That's exactly right of you to point out, Brad, because Fed Chair Powell pouring more cold water on the idea of a March rate cut. He reiterated that this is just 7 weeks away, which crazy to think that that next Fed meeting is in just 7 weeks here. But he said, quote, we just want some more confidence before we take that very important step of beginning to cut interest rates. So what does that look like, right? More of that two handle on the interest prints, the inflation prints that we've been getting rather, right? More of that 2% range when it comes to the super core PCE print. That is what they are looking for moving forward. Having said that, I'm taking a look at what we're seeing here in the trade this morning. The dollar obviously up as we are anticipating a higher for longer move from the Federal Reserve, but seeing red across the screen when I look at the major indices, the Nasdaq, the S&P, and the Dow. That is an indication to me that Meta's stellar print on Friday is not going to be driving today's trade. It's actually about Chair Powell's statements. That's going to be driving our Monday morning here. And it's interesting in a week that we don't have a ton of economic data, so I'm curious to see whether the earnings prints this week are going to be driving the trade moving forward. I think about a McDonald's missing so much this morning, and comparing that to Meta adding the entirety of McDonald's market cap to its own market cap on Friday. Is that big tech rally going to be able to continue to lift this market?
All right, Maddie, we of course will be watching that. Let's head over to Jared Blickery, who's standing by with a closer look at some of the movement that we're seeing to the downside, Jared.
Yeah, a little bit of a downdraft, not huge, but the Dow is leading, down 0.4%. And if you're taking into consideration the small caps, that's actually the worst by far. It's down 1.4%. And we'll get more on the general market in a second. Just want to check in early on the sector action. We're seeing some strength in the chip space, a little bit of software. So we're seeing tech in the green for 0.4%. But for the most part, lots of red. As you can see, the dollar's been heading higher. Materials is weighing down. That's down over 2%. Real estate and utilities, those are interest rate sensitive sectors, and consumer discretionary as well. And now energy, all of those down more than 1%. And let me just show an interesting comparison here, because with the disruption trade really faltering today, I've been seeing this around Twitter here. Here's one of two: Berkshire Hathaway versus ARK Innovation. This year alone, Berkshire up 9%, ARK down about 12%. Last 3 years, look at this: Berkshire up 65, ARK down 69%. And then Meta versus Tesla. This year alone, Meta up 32%, a lot of that coming Friday. Tesla down 26%, and there's another long-term story for you there. But the bottom line is we're seeing a little bit of weakness. We're seeing yields kind of screaming higher here, and also the dollar. The dollar is finally weighing on stocks once again.
All right, Jared, thanks so much. Let's continue to talk about the movement that we are seeing here as we start the trading week. Stocks are lower here shortly after the open, yields moving to the upside. Traders scaling back their bets on an early rate cut. Fed Chair Jay Powell reinforcing his message that it is unlikely the central bank is going to see enough evidence that inflation is moving sustainably down to the Fed's 2% target by the next meeting in March. We want to bring in Brian Levitt joining us here at the desk, Invesco Global Market Strategist. Brian, it's great to have you here. So I'm curious just to get your reaction to what we heard from Powell, not only at the press conference last Wednesday, but also what we heard in 60 Minutes last night, and what that means in terms of your expectation for a rate cut.
Well, first and foremost, I'm thrilled that we're done with the tightening cycle, right? That is critical. I think the market's priced in too quickly the 6 interest rate cuts. And, you know, that rally, that cyclical everything rally in November and December, I wish it would have lasted a little longer. So now we're recalibrating. Basically, what we heard is that don't expect the 6. We are done tightening. We'll slowly bring down rates, but we'll be data dependent as a result of it. To me, it's not a huge issue for markets, but just a shift in leadership, so to speak.
What's the real number of rate cuts that you believe that we're going to get this year?
Probably looking more around 2 or 3 rather than 6.
No.
I think the market went to 6 because that would have normalized the yield curve. And at some point, if you don't need 5.25 funds rate, if we're not going to be a 5% nominal growth country, which we're not. So at some point you normalize it. But I think the big challenge for investors now is the normalization of the yield curve typically means weaker dollar. It means small caps, mid caps, value. That all happened in 2 months. And so now you're getting a bit of an unwind of that stronger dollar, rates up a little bit, more tech outperformance. So that may be tripping investors up for a little bit. I would say if you're looking over the next 1 to 2 years, focus on that normalization of the yield curve because it is going to come.
So I'm happy you brought up the small cap discussion, right? Because we've been talking a lot about the fact that maybe that a lot of that optimism had already been priced in. We have not seen that trade really take off, at least since the start of the year, given the outperformance that we've seen in tech. What do you think the volatility that we've seen within that play, and we have the Russell 2000 up on the screen right now, tells us about some of that price action that we could see in the coming months?
Well, we were up 20% in small caps, Russell 2000 in 2 months. So you got a bull market in a blink of an eye. And, you know, for people like me who write outlooks in October, that's your call for the whole year, right? And it happened in a blink of an eye. So what do small caps need? They typically need easier policy. They need a cyclical upturn in economic activity. So you were getting that soft landing feel. Now you're just pricing some of it out with not pricing out soft landing, but recalibrating where interest rates are going to be. So small caps fall under some near-term pressure. But again, small caps do very well as the Fed eases, as you normalize the yield curve. So we still have that ahead of us. We're just in a patch right now that's favoring mega cap again.
Internationally, as you kind of look across the global scene here, where are there the pockets of pressure that you're seeing that are cascading into portfolios where investors should be making some type of pivot?
Well, I think what investors probably are missing in places like China and in Europe, growth had already deteriorated pretty significantly, and you're below trend in those parts of the world, but actually maybe starting to improve a little bit. Now, don't get me wrong, stronger dollar is disruptive of that, so you will need some carry through in terms of rate differentials between the U.S. and the rest of the world narrowing. So the dollar under a little bit of a pressure right now hurts international, again, in the near term. I hate to keep saying the same thing, but thinking out over the next couple of years, will we finally be out of this COVID cycle? Will we finally have a normal yield curve, reasonable growth, normal inflation? I would say yes, and that's, to me, when you start thinking about beyond the U.S. megacap.
What does that normalization look like, though, right? When we talk about the fact moving beyond the movements that we've seen and the astonishing activity that we saw during COVID, getting back to those more normalized rates, I guess, what exactly does that look like to you?
Well, if we think about it, I mean, what a crazy 4-year period, right? And so you shut down the global economy, put a lot of money in people's pockets before the world's ready for it, raise interest rates 525 basis points, and now we're battling back and forth. Soft landing, no landing, hard landing. What does it mean? It means that over time, the Federal Reserve has to ease policy in a more normalized. We're not going back to 9% inflation. Inflation's coming into the 2s. We don't need 5.25 Fed funds, right, with inflation in the 2s. And so we're going to slowly bring down rates, and we're going to get back to an environment where short rates are below long rates, the way it's supposed to be, and that'll reinvigorate credit and reinvigorate economic activity.
In order to get back to that normalization, we're going to have to move through one of the biggest election years worldwide that we have ever seen.
Yes.
What type of headwind, what type of volatility could that ensue?
Well, my message to investors for years has been that focusing too much on politics or the government is not a great investment strategy. In fact, the way we used to say it was hating the government is not an investment strategy. And in the U.S., there's going to be a lot of focus, Trump v. Biden, which we assume will be the race. If you go back and you look historically, you can go back to Eisenhower, just about every president experienced positive returns over their term. And if for all the focus in 2016 and 2020, if you look, Biden was elected something like 820 market days ago. The market is up 46, 47% since that election. What do you think the market was up in the first 820 days after Trump was elected? About 51%. So they're just about neck and neck. These things don't matter nearly as much. I would focus far more on the Federal Reserve than I would focus on what outcome we get in the executive branch.
Brian, always great to get your insights, the context here. Thanks for joining us in the studio. Brian Levitt, Invesco Global Market Strategist, everyone. Coming up, McDonald's seeing global sales fall short of expectations, but touting a resilient business. We're going to speak with an analyst from Bank of America next.
McDonald's shares falling in early trading off just about 3%. The company missing on global same-store sales. It fell short of the street's expectations, rising just 3.4%. One of the big challenges for the company in the quarter was disruption and the ongoing conflict war in the Middle East. We want to bring in Sarah Senator, Bank of America's senior restaurant analyst. Sarah, it's good to see you. So taking a look at least the early reaction to this report, shares off just about 3%. When we focus in on the disruption in the Middle East, the ongoing war that is happening out there, how big of a challenge do you see that for McDonald's in the coming quarters?
Yeah, well, thank you for having me. And I think the impact of what we're seeing is broader than just the stores in the Middle East. As a percentage of the McDonald's IDL, International Developmental License market, those are only about 10% of stores. So I think we're seeing, the implications perhaps of those geopolitical tensions much more broadly. And that's why you saw such a sharp deceleration in that IDL segment, same-store sales.
And so all these things considered, McDonald's moving forward from this point, they're still going to be looking at some of that international expansion where they can continue to move that forward. How does navigating this environment, what does it look like on the other side if McDonald's gets this right versus gets this wrong, and where do they have to kind of introduce some categorical shifts, perhaps even within the menu items that they take into those regions?
Yeah, I think the issue is probably broader. So from the perspective of just the Middle East tensions, I think McDonald's articulated and probably the right view, which is it's going to be very hard for McDonald's or really any American brand to change things dramatically as long as this conflict or these tensions continue. I mean, there are obviously marketing and messaging changes that they can make to affect perceptions, but I think right now the focus will be on the things that they can control in their broader footprint, which is primarily about value. So we are seeing, we saw some softening in France, even to some extent related to value proposition. I think what we've seen in the U.S. is an intent to broaden out their value just to, I think, address the fact that consumers are still feeling under pressure. And this is a kind of a global phenomenon, at least in the U.S. for the lower income consumer. The middle and upper income consumer still seems to be spending pretty robustly.
So what's your read on the consumer from these results? And more specifically, I bring that up just because of the price action that we've seen, or the price increases, I should say, from McDonald's being able to offset some of those inflationary pressures. When it comes to the consumer's ability, though, to keep paying some of those higher prices, especially on the lower income side, how are you factoring that into the potential risk or challenges that could pose to McDonald's?
Yeah, so I think, one of the things that we have to keep in mind is that, we've seen inflation across the broader economy, and certainly we've seen it within food in aggregate. So we saw it in the grocery stores as well. So as we think about, the high single digit price increases that McDonald's took in the quarter, it's in the context of, relatively high inflation, or at least, up until very recently, relatively high inflation. I think the key will be for McDonald's pricing to get more in line with that inflation. So to the extent that inflation has come down pretty meaningfully, the goal, I think, for McDonald's is to make sure that they're not running ahead of that, so their relative value proposition stays strong. And to your point, the lower income consumer is the one who's been under the most pressure because they are feeling the impact of inflation in a more pronounced way. But we are starting to see real wage growth turn positive for that consumer. And I think, again, as long as McDonald's and other restaurants can maintain a value proposition that is attractive relative to what else is out there, we are seeing resilience in the consumer.
So, Sarah, then do you think McDonald's could potentially lower their prices in order to, like you were saying, be better in line and more balanced with the trends that we're seeing within inflation?
Yeah, I mean, typically we don't see menu prices come down. That's sort of a phenomenon. Menu prices only kind of go in one way. But what you can see is realized price come down. So that means more promotions, whether it's, digital couponing or national price point promotions that are temporary in nature. So I think that's what we'll probably expect to see. And frankly, that is what we have seen in the past. Whenever we see inflation come down, especially if you get into a case of deflation, you do tend to see more value competition.
Sarah, while we have you, we've been firmly within this tenor of buying on the dips, more largely in the market. There's a dip in McDonald's year to date, at least as of right now. For investors that are trying to figure out if they should add the golden arches to their portfolio, can they feel comfortable buying this dip with what the company has put forward within this earnings result?
we're neutral on the stock, and that's primarily because this is a very stable earnings model, which cuts both ways. So on the one hand, you don't typically get a lot of upside from earnings, and certainly, if there is some headwinds on top line, that'll be harder to get. On the other hand, you also don't see a lot of variability to the downside, and I think we saw this quarter G&A was run very tightly so that McDonald's could achieve earnings growth in line with consensus, even with a slight same-store sales miss.
All right, fair enough. Net neutral. Sarah Senatore, who is the B of A Securities Senior Restaurant Analyst. Sarah, thanks so much for the time and the insight. Appreciate it.
Thank you.
Coming up, Caterpillar jumping this morning after blowing analyst expectations for the fourth quarter earnings out of the water. We'll dive into those results next.
Caterpillar shares surging to an all-time high, up just about 3% after the company beat on fourth quarter profit expectations. Construction giant seeing equipment volumes and international construction sales fall, but higher prices made up for some of that decline. We want to bring in Michael Schliske. He's D.A. Davidson Managing Director of Equity Research. It's great to have you here, Michael. Let's talk about this report because, yes, we are seeing shares move to the upside, up just another 3% today. Demand staying resilient, yet there was some weakness, especially when you look at the international component.
Yes, there was some weakness. Certainly North America still drives the bus at Caterpillar. So there seems to be not much of a slowdown there, particularly in construction, where obviously they're one of the strongest players, if not the strongest globally. Outside the U.S., though, they did mention some slowdown in Asia excluding China, as well as China itself. They think that China will be a somewhat weak year. It's only 5-10% of sales, but certainly if that's going to be an additional weak year here, probably their third in a row, international is going to be a challenge for the near term.
So with that in mind, they mentioned favorable price realization. How much additional price can they push through?
Well, for the last couple of years, Brad, it's been well over 5-10% of price on average. It's getting a lot more normalized, especially in the first half of the year. They'll get a few percent. It might turn flattish or just slightly up in the back half of the year. That's probably a good thing. They have much better visibility on their manufacturing costs. They have much better visibility on their dealership inventories. And so having a somewhat muted, low, modest increase in price over the prior year, it probably is not the worst thing in the world for Caterpillar at this point.
Michael, supply chain constraints has been one of the storylines for Caterpillar of the last several quarters. What does that look like? Has that started to ease significantly?
It started to ease mainly. However, there's one area that they will be expanding in, and that's their large engine business. It has been capacity constrained. They've had great demand there across most of their end markets, mining, oil and gas, heavy industry, et cetera. They are going to spend the next year or two investing more in that capacity. But yes, otherwise it has largely caught up.
Does Caterpillar have an artificial intelligence play, Michael? It feels like we hear so much from the industrial companies and construction companies about where that can be embedded even into some of their equipment that they're trying to put into the market. Is there a story there at all?
There is definitely a story there, Brad. It's probably a few years away. Two areas where they're kind of looking at it. One is in safety. So what's been a challenge is trying to find labor that can actually use these complex machines. If you make some of the safety areas of the equipment easier to use, you can perhaps widen your labor pool. So that's certainly one area. The other is in asset tracking. So they have some of these I think on there already, but it's helping to position the machines for optimal performance in the field. So yes, it's not this year, but certainly over the next 2 to 5 years, I would think we'd see a lot more autonomy in their portfolio.
Michael, Caterpillar often looked at as an economic bellwether, right? When you take into account the demand that they're seeing for the machines, normally or many times looked at as a leading indicator. What do you think this tells us just about what we will likely see play out for the rest of the sector this earnings season?
Well, it certainly sounds like there's a lot of confidence out there among U.S. construction companies and their various fleets, whether their own fleets or if they are rented. So it does suggest, as you would imply, that people are confident with making investments in 2024 in equipment, even in a higher interest rate environment. If we start seeing rates go lower, I wouldn't be surprised to see even additional confidence, I think, from the construction sector.
Michael Schlisky, who is the D.A. Davidson Managing Director of Equity Research. Michael, thanks so much for taking the time here with us today.
Thank you.
Absolutely. We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Good morning, everyone. I'm Brad Smith alongside Shauna Smith. We're about 30 minutes into the trading day. Let's take a look at how things are shaping up right now as we hit the top of the 10 a.m. hour. Stock slightly lower after comments from Federal Reserve Chair Jerome Powell signaled rate cuts not coming in March. Here you're taking a look at the S&P 500 down by about 0.25% here this morning.
Shares of Citizen Financial relatively flat this morning after Citigroup upgraded the stock to buy from neutral. Now the analysts there are telling investors to play offense rather than defense in the current environment for banks, explaining that the best time to own bank stocks is when valuations go from late cycle to early cycle multiples. But again, stock though still down off about 0.3%.
And B. Riley downgrading shares of Six Flags from buy to neutral. Analyst Eric Wold seeing the merger between Six Flags and Cedar Fair as a better play for Cedar Fair, regardless of the outcome. The analyst explaining that it does not matter if the deal goes through or not. Cedar Fair will come out as a winner.
And it turns out Barbie might not have been enough for Mattel. JP Morgan downgrading shares to neutral from overweight, citing a smaller tailwind from the Barbie movie than initially anticipated. Now, the analyst there explaining that the duration of the Barbie boom was, quote, unexpectedly short and created significant wall of worry for investors. Now, the analyst also listing weak holiday sales, a shorter holiday season, and unexpected freight costs as other reasons for caution surrounding the stock. You're looking at pressure of just about 3.5%. But again, this report is really going to give us a solid reading on the consumer, what demand looked like during that critical holiday season. And that's what they were pointing to here in this call from JP Morgan. Just the fact that, hey, maybe it didn't live up to those expectations and we could see further pressure on the stock here later this week.
I respectfully disagree with this call, and here's why. At the end of the day, you had so many people buying Barbie core, buying Barbie products, buying Barbie everything ahead of the movie a year before it even came out, before we even got the
already priced
full
in.
trailer. Yes. So already priced in at the end of the day. And so for us to expect it to just continue to be this ultimate every year people should just keep buying into Barbie, there is normalization that would happen afterwards, and we should have expected that. And at the end of the day, we'll see how many people keep wearing pink everywhere. Look, I got some pink socks even in the craze and dressed up to go to the movie, but at the same time, I'm not going to be drinking rosé the same amount that I was leading up to this movie.
Did you dress up as Ken to go to the movie?
Yeah. Like a Tyler Perry Ken.
How did I not know this?
Well,
I wish we had the picture ready for this segment because that would have really made it. But again, that points to the fact that it really did start this whole revolution. When you talk about what this would mean for Mattel stock going forward, it's what they're going to do with their other IPs that they have.
Right,
exactly.
Hot Wheels, right?
Exactly.
Yeah.
That's one of the movies that they will be making here in the future. So whether or not it's going to spark any sort of excitement that was similar to what we saw play out with Barbie.
We'll be buying race cars leading up to that. People are not going to get dressed up as a toy race car to go see a movie, but hey, you might wear some race car colors. Who knows? Know. We'll see. We'll see what happens. We'll workshop it out there. And a bonus trending ticker for you. Palantir set to report earnings after the bell. Investors looking to see if the big company and their big bet on artificial intelligence will pay off. Wall Street remains cautious on what the company will release in terms of revenue and profit. Analysts seeing rising competition and macro headwinds for Palantir. There you're taking a look at shares. They're down by about 0.7%. Don't look at that screen, but hey, look at me. Ultimately, at the end of the day here, this is one of our top trending tickers on the Yahoo Finance platform.
Yeah, it's just going to give us a better sense of exactly the impact that AI is having specifically on Palantir, because a lot of that optimism has arguably already been priced in. You're looking at shares up over the last year of 100%. So under a bit of pressure here today ahead of these results. What we hear from the CEO, whether or not that is going to live up to those expectations. Citi out. They have a sell rating on the stock. They're cautious ahead of this report, saying that they expect the federal deal activity to underwhelm here in the quarter, and it's not going to be enough to offset some of the strength that they are seeing in U.S. commercials. So it won't be enough there to in order to really propel this stock here to continue moving forward to the upside. So some of that optimism already priced in. It's more of a show me story. And at least from the streets, early take ahead of these results, they don't expect too much to come from this.
Absolutely. Well, speaking of show me stories, show me Ghostface Chilla. Put him up on screen here. Snap, the latest tech company to announce job cuts. The social media giant saying it will cut 10% of its global headcount to free up capital to invest in its long-term growth plans. This comes just ahead of the company's fourth quarter results tomorrow. Shares are edging lower this morning. Joining us now, we've got Rohit Kulkarni, who is the Roth MKM Managing Director here. Rohit, what is this set up for what the company will say once they do release earnings?
Hey, thanks for having me. And I would say that expectations for Snap have been rising, given what Facebook, Amazon, Google told us last week. Again, advertising remains strong. I think expectations have been going up, while Snaps remains in somewhat of a slow recovery mode. I would just put it that way, that they are trying to recover from all the changes that Apple inflicted, plus their loss in executives during all of 23, and now they are losing more employees. So I think it still is a prolonged turnaround story, in my opinion, and I think we remain cautious heading into earnings tomorrow, given expectations are going higher and they're cutting off employees doesn't bode a kind of encouraging sign for the demand curve that they may be seeing right now. That's the only time you would probably cut employees at 10% or more.
Rohit, so comparing Meta to Snap, and I realize it's not an apples to apples comparison, but I bring this up because of what we heard from Meta last week, the ad recovery story, clearly the driver there in the results and also the reaction that we saw post results. When you compare what's happening at Meta to what's happening or not happening at Snap, what do you think Snap needs to do in order to better benefit from the recovery in the ad space that we are seeing play out in some of their competitors?
I hate to play this buzzword bingo with you guys, but it's AI. I think what Facebook has done since, say, late 21, all of 22 and half of 23, they have invested in AI in a way that they can recover some of the lost signals from all the changes that Apple and all the privacy changes have been happening in the ecosystem. So I would put it that Facebook is probably maybe 6, 9, 12 months ahead of a company like Snap when it comes to fixing what was broken because of Apple and ecosystem changes. In the meanwhile, Snap is facing its own issues. They are losing a lot of executives. They are losing some key people on the team. And while that is happening, they're falling a little bit behind on their kind of quest to become a direct response, which is kind of the bottom of funnel, real secret sauce, large addressable market advertising play. So probably give them 6-9 months, in my opinion. If they can fix it, they'll be able to fix it in that time.
So does that mean that Facebook or Meta and how they're operating right now, are they more of perhaps a social media anomaly in just the size that they are, the scale that they have as well, and the amount of advertising dollars that flow into them versus some of the other social media and digital advertising plays out there?
I think so. I think Facebook is out executing absolutely everybody else in the ecosystem. Facebook probably lost a lot of market share during 2021 and 22, and they are showing that they can regain most of that lost market share and plus probably gain more market share because of the way they're executing, the way they're investing in AI, and they're investing in surfaces that could be monetized at a much higher rate. So again, Facebook is gaining share, and that's why they're putting up the numbers that they are doing. Ad market has recovered, but not completely recovered in a way that we are in the hunky-dory days of back in 21. So probably we are somewhere in between, and that's where smaller companies like Snap continue to hurt as they see some volatility in some of their customers.
Rohit, so let's compare this to what we could hear from Pinterest, because that's another stock that has risen substantially over the last 6 months, up 43%.
Yep.
What do you expect to hear from Pinterest? Will it live up to those expectations? That looks like it's been priced in.
Yeah, I think I would say if Snap's expectations have gone up from, say, 0 to 4, Pinterest's expectations have gone up from 0 to 10. So the expectations for Pinterest to have a very significant beat and raise are much higher right now. That means for the stock to move on up from where it is right now, they need to put up really solid numbers. And some of it is because of what investors have started to believe around the partnership between Pinterest and Amazon. So they have been working towards getting more of Amazon ad dollars into Pinterest, and it's been a positive, really positive step. But whether it is a significant positive to move the numbers on Pinterest, that remains to be seen, and that's where whether Amazon drives Pinterest ad revenues much above and beyond. Bulls believe that is going to be the case in 4Q and 1Q. We are on the sidelines. We think Pinterest is priced for perfection right now.
Snap or Pinterest, or maybe even Meta, are any of them well positioned to capitalize on the fallout that we're seeing right now from TikTok and Universal Music Group and some of the end users, daily active users that have used that service as well?
I think, in my opinion, the way eyeballs or share of mind goes is always goes to the larger player first. So I wouldn't be surprised if Facebook remains the primary beneficiary, probably followed by a little bit of Snap. But that's how I would see that majority of the incremental share of mind or the time spent probably moves towards Facebook, if there is any, and then perhaps a little bit of user base overlap that exists between TikTok and Snap. Some of those users gravitate towards Snap a little bit more, but majority would still be Facebook or Instagram.
All right, well, we'll hear from Snap on Tuesday, Pinterest on Thursday. Rohit Kulkarni, always great to get your insight. Roth MKM, thanks so much for joining us.
Thank you.
All right, well, Chinese policymakers vowing to prevent, quote, abnormal market fluctuation after last week's brutal sell-off in Chinese stocks. Investors, though, might need more convincing. Wild swings continuing in equities to start the week. We've seen about $7 trillion erased in values of equities in China and Hong Kong since their peaks in early 2021. Jared Blickery has a closer look at some of the moves that we're seeing. Jared.
Blame the short sellers. That is where we are in this playbook. And we're seeing the Chinese Securities Regulatory Commission come down in quite a hard way on not only short sellers, but also sellers that are engaged in a market neutral strategy. So that's long sum, short sum. At the end of the day, all this means is the Chinese government has lost complete control over their stock market. Now, we are seeing some reaction to the upside here. Not a lot, but we've seen this before. But you take into totality of the year to date, and these are the members of the Nasdaq Golden Dragon China Index, we're seeing some serious losses here. I'll sort by performance. And you can see the middle stock here, the median stock is actually down 20% or more. And if I go back 1 year, it gets worse. You can see the median stock down about 43, 44, 45%. So almost half of the value wiped off for the median stock here. Now, what can the Chinese government do going forward? Not a whole lot. They've been engaged in a piecemeal strategy trying to target specific areas of the economy, and that includes real estate. It also includes the stock market, but it has been failing, and we can see that evidenced by these numbers here. The real problem for the Chinese government is that if they stimulate too much, their currency gets devalued, and that's what they're trying to prevent, because then you get capital outflows, all kinds of negative knock-on effects then. But here's the US dollar versus the Chinese yuan. If it's going higher, that means the yuan is weakening, and it has been weakening. And by the way, those are multi-year highs up there. Let me put a max chart in. These highs are what we're up against here. And the thinking is that if the market were to go higher, yuan weakening, that would only accelerate to the upside. So that's what the Chinese government is trying to prevent. But if you want to see any inkling of how much China is a drag on emerging markets, just look over the last 3 months. Here's EEM. This is iShares EM ETF versus iShares EM ex-China. Ex-China is up 7.6%, still underperforming the S&P 500 of 13%. But nevertheless, there are some gains out there, but you got to remove China from the equation.
All right, Jared, thanks so much for breaking that down for us. Certainly good things for investors to keep in mind for today. All right, well, coming up, why Nike might be the strongest bet in retail stocks this year. We will be speaking with Adrian Lee, Barclays Consumer Discretionary Senior Analyst, next.
A new generation of retail traders is flocking to options trading as an alternative to plain vanilla stock investing. But the options arena can be complex to maneuver, and there are also pitfalls to avoid. So we're starting off with the basics in Yahoo Finance's Options Week 101.
Well, it's important to remember, Jared, that it is a right, and that's where the word option comes from, as opposed to, let's say, a futures contract or actually buying the stock, where you're obligated to own that underlying security. As a result, the price tends to be lower. But the very important parts are you have to get that target price correct because there's a predetermined price, and you have to get the time frame correct.
If you get into options, number one, it requires a certain degree of focus and activity because options expire all the time. And the other would be understand your risk before you enter into any position. Structured is define risk if you're brand new to these markets, but most importantly, understand what that risk is, what it looks like for various outcomes.
And what we're looking at here is just a sample of ideas that one can do based on the implied volatility environment that we are in currently. So you don't want to just buy a call if you're bullish or buy a put if you're bearish. You want to take implied volatility into consideration to stack the edges in your favor.
We have to focus on risk versus reward. So whenever we're buying a stock, the most that we can lose is the most that we spend, right? But when we're trading, we always have a price target in mind. And these are very essential components when we talk about options. We just add that layer of complexity because it's a derivative of more than just the underlying security. We've got time and implied volatility as well. Never hold an option till expiration. That's the worst thing you can do.
I've done this, by the way.
It's risk. If you hold the option, you lose giving up the time value. And then if you are short the option, then you actually have what's called gamma risk, and you have a huge issue of being unprofitable very quickly. So trade small, trade often, as they say at Tasty Trade.
Barclays out with a note on Nike, reiterating its overweight rating on the stock and price target for the retailer. Now, the analyst behind that call, Adrian Yee, naming Nike its best idea for 2024. And this call coming as Nike has really failed to regain some of its momentum over the last several months since the start of the year. The stock off just about 7% over the last year. We're looking at declines of just over 20%. It's also falling another 1% today. We want to bring in Adrian Yee, Barclays Consumer Discretionary Senior Analyst, to discuss more. And Adrian, when you take a look at this name, you're still bullish about what Nike maybe is going to prove in 2024. What are the catalysts ahead for this stock?
So the catalysts are really, number one, that they absolutely have their inventory. So the supply side of things is inarguably fixed. And so that's half the battle, right? So they want to get to a pull market where their wholesale channel partners are ordering, replenishing, restocking from them. And that's a guaranteed sort of plus to the revenue. We don't think that's happening in the first half of the year at all. We already know that all the retailers are still buying down and very conservative, but you have to have a replenishment cycle of newness. And that's where the innovation comes in. The catalysts are a whole slew of innovations coming for this year, the likes of which we haven't seen in 2 years. And I can go through those in a second, but that's really the two catalysts. Innovation to drive top line, supply is tight.
Adrian, when you mentioned innovation, I was just reading in recently on that new Air Max DN, that platform particularly, and it really seems interesting where for a shoe company that's had so much success with the retros, that gets everybody clicking, that gets people going on to a sneakers app and crashing the dang thing all the time, where they're balancing innovation and need to balance innovation with what people have just flocked to in the past. And so what is the correct way that investors should be grading the company on how they execute that?
They should be grading the company on what is new and the incremental unit newness. So what's going to get the consumer to spend, the dollars on a new pair of shoes. I can appreciate the retro, side of things, but that's been the problem with Adidas, with Vans, and with Nike. They're selling the same things over and over, and it's getting, quite frankly, kind of boring. They sort of missed out on what I call the soul wars, like On, Hoka, these high-profile platforms. The Air Max DN is coming in March, on Air Max Day, March 26th, mark your calendars. Right after that, they're going to have the Peg 41, the Pegasus 41, which is a whole new form factor. So that's brand new. And then they're going to follow with Copa America in June, and then the Paris Olympics. All this is newness and innovation. And what I'll say is, when you have the newness, people don't immediately buy, but this is the first time we've seen kind of the leadership, right, led new by Heidi O'Neill, that is just focused on speed, hustle at scale.
Adrian, what do you think the margin recovery story looks like? And more specifically, you and I have talked so much just about the inventory levels with Nike. There has certainly been a lot of improvement over the last several quarters, but where do you think they stand as we look out towards year end in terms of that continued improvement that many analysts have been calling for?
So fiscal year end for them is May. And this is a pretty anemic, they just lowered guidance. Plus 1% top line sales. Consensus is looking for a 12.3% operating margin. That's below the 10-year average of 13%. Right. So this is, so what we always say is they just got their inventory clean sort of at the end of July, clearly at the end of November. It takes about 2 quarters for it to percolate into the system and run through the income statement and the margins. So we're seeing, kind of the back half of this calendar year, but certainly for FY25, 150 to 200 basis points coming just from cleaning up the inventory, not, spending money on storage, losses and damages. Just all those kind of ghost inefficiencies and all the friction that comes with just being supply chain and inventory inefficient. And so we haven't even put in the top line recovery. If we want to talk about top line recovery over the course of 25, 26, 27, we think there's probably 400 basis points, right? 200 in the near term from below the top line, another 200 basis points from leverage. So 12%, 13%, high teen margins over the next 2 to 3 years.
Adrian, while we have you, one of our producers brilliantly wrote up last week that City Boys are up as Lululemon is coming out with their new men's shoes here. We think across the Cityverse, the casual shoe, of course, that is set to start things off, plus the performance styles. What does a successful entry into that performance and just overall footwear market in men's look like for Lulu from your perspective?
So Lulu is, as you said, very newly launching. It's gotten, good kind of PR on websites, et cetera. We're really excited for this piece of the business. But just remember, for Lulu, men's and women's, the entire footwear is a low, 2% of their 5-year plan. Right. So I love Lulu because they take these big risks, but then they don't put the execution is not a big risk on the P&L. We're very hopeful that it completes sort of that whole head to toe outfitting. It opens new TAM categories. Lulu is just excellent and has been excellent at kind of keeping that innovation pipeline. And remember, the launch of the shoe is a 5-year investment for them. So through and through the pandemic, they never let up on that product design and development. And so they're winning.
Adrienne, I feel like you and I could have a really good sneaker podcast one day. I'm just going to throw that out there. Do with that what you will. But at the end of the day here for Lulu, I mean, this really kind of in the category itself, the contribution, what should investors expect for how early this can be a contributor to the company and the broader pillars that they've laid out?
So, if we think about apparel companies that have entered footwear, right, it's tough, right? Footwear kind of going to apparel, you kind of have that brand out there, but Lulu already has that brand. If we think about long term, right? So it would not be unusual to think about 60%, 2/3 of the business coming from their core apparel and 25% over time kind of coming from this footwear and accessories piece of the business. That's obviously a long time away. But the fact of the matter is when you have such a strong brand and then you platform that onto footwear is the kind of completer, particularly with men. I always like to say this, boys and men like to dress from the feet up, right? You spend a lot of money down on your feet and then, I don't know, kind of not a lot everywhere else.
Look, you're not lying. I feel personally attacked almost, or just really seen right now. Adrienne Yee, Barclays Consumer Discretionary Senior Analyst. Thanks so much for joining us here today. Always a pleasure.
Great to see you.
See ya. We've got market action for you up ahead. The sell-off is accelerating here across the major averages. You've got to look at it in the corner of your screen here before we go to break. Maybe overly optimistic is what these markets are telling us, perhaps. We're going to be joined by Tiffany Wilding, who is the PIMCO Managing Director and Economist, after the break.
Really, you're only missing NVIDIA in terms of massive tech companies to report this week. And really, guys, I think the story here is understanding how big this is going to be for the overall market.
It's another year of overcoming a lot of challenges. As we think about 2024, it really is a year of execution for us. We've got the roadmap. We talked about 200 to 300,000 EVs being produced this year. We've got confidence of getting to variable profit positive in the second half of the year on our journey getting to mid-single-digit margins by 2025.
People are really focused on this move to generative AI, and that seems to be a very big focus longer term for the street, where Google has had basically a monopoly on search. With generative AI, you've got different players at least trying to dethrone them in some way.
Generative AI is 1 year old. We're 1 year into this new AI cycle. Microsoft, they disclosed their AI business actually doubled sequentially. It's now a $4.4 billion run rate business in year one.
We had a strong quarter in Q1, and it was really driven by our most loyal customers remaining engaged across the globe. And so as we think about going forward, as we look to some maybe more near-term and transitory headwinds, what we're really focused on is continuing to drive customers into our rewards program.
The fact that there's no guide here isn't really a suspension so far as I can tell, and I would attach that to not wanting to get ahead of the FAA. The FAA has asked for a freeze on the 737, arguably the most important product they do, and I think they're just being smart and not trying to get ahead of the regulator.
We're really happy and very proud about the results we delivered this morning. Being able to grow the company by 36% is historic in our context, and in an industrial context in the pharmaceutical industry, growing 36% in an industry growing to the tune of 4% is also very, very special.
When people buy a new phone, they're buying a more expensive phone. And so we're seeing this tremendous mix shift towards more expensive devices, towards more expensive chips. And that shows up in our revenue growth.
The strong guidance for Q1 got it essentially above the street for revenues for Q1.
And then the dividend, obviously investors are going to like that, showing continued expense discipline on their part. And so we think investors are really more focused probably on the guidance and the dividend for Meta.
At 13.2 billion, which is what they did in the quarter, you have a trajectory that's, leading the company towards kind of a 10% bogey in 2025 now, which is not something that investors were expecting.
The number is a miss overall, but I think it's not a major disaster because it's all about the future here going forward, how they get the generative AI into their whole mix and all that. So there are a lot of other levers that they can pull, but at this point, it is definitely a disappointment that two areas that we were concerned about did disappoint.
Optimism for seeing a Fed rate cut in March is dropping significantly, down around 15% from 46% last week, according to the CME FedWatch tool. This comes after the strong jobs report and Federal Reserve Chair Powell's comments. Let's bring in Tiffany Wilding, who is the PIMCO Managing Director and economist, to discuss what we could see from the Federal Reserve ahead of March. Tiffany, just walk us through your timing, your thesis as to what's this next few months, especially as we continue to think about the upcoming meeting schedule, what they could signal about the pace of some of their cuts.
Yeah, well, all of those are really good questions. And I think as just taking a step back, really what the Fed is trying to balance right now, obviously, is the risk that, maybe the job isn't done, inflation settles somewhere above target. with the risk that they're going to do too much and sort of needlessly weaken the economy. And the data, quite frankly, hasn't really been that useful. Well, obviously the data is useful, but there's been some question that's arisen from the data because on the one hand, we have very strong growth and what we would argue is still tight labor market, although it's eased versus last year. While on the other hand, inflation has come down. So obviously this has been almost a too good to be true kind of experience. And I think the Fed, just wants to be sure that inflation's coming down in a sustainable way. So what does all that mean? Well, we had been arguing that March was probably a little bit too early. Chair Powell confirmed that at the most recent FOMC meeting. We think FOMC officials themselves are looking more like a mid-year, maybe a June timeframe for the first cut. But then after that, their own forecast suggests that every other meeting pace could be likely. But when we look historically, what we found is that in rate cutting cycles that were not coinciding with recession, something like in every meeting pace, is maybe more likely. So maybe they get going a little later, but they start to go, when they do go, they go a little faster than their current projections.
Tiffany, what does all this mean then for the jobs market? Because just looking back at Friday's number, obviously much hotter than what the street had been anticipating, what many economic forecasters have been expecting to see on that print. Will we be able to, or will the Fed be able to orchestrate and pull off this soft landing without causing too much harm to the labor market?
Well, so I think that is really the key question. And obviously the Federal Reserve officials believe that they can, and one of the things that we would just note here is that for the unemployment rate to stay consistent, to stay constant, the neutral level of jobs that the economy can create is about 100K per month. Now we've been creating much more than that, 250, 300K in the fourth quarter. It is well above that. So eventually that kind of job gain should put some downward pressure on the unemployment rate. And that's a hot economy that should result in support of inflation. So I think the Fed really wants to be careful here. I do think you need some weakening in the labor market and labor demand. One of the reasons why we haven't seen the unemployment rate increase as a result, despite the fact that jobs have been strong, is because we've had labor supply that's come back. Some of the folks that maybe took a time out after the pandemic have come back, and obviously immigration has been quite strong this year. But ultimately those factors, they look set to fade. And so we really kind of need some cooling off of the labor market here in our view in order to get inflation sustainably back to target.
Does all the data right now say soft landing or does it say no landing? And what does a no landing look like, Tiffany?
Well, I think it's all a matter of timing, right? The markets are going to trade, economic data, can certainly lead markets to trade one way or the other. I think ultimately our own view is that probably over time, over the long run, no landing is really not an option. Chair Powell has said, that, in not so many words, that he doesn't want to be Arthur Burns. They're not going to stop until they get the job done. And so, that's why they're being very careful here. And as I mentioned, I think that balance, the balance of risks here is that they maybe wait a little bit too long. They're delayed in cutting, but then they have to cut a little bit faster than they're currently projecting. So I think eventually we will get back to 2, but right now the economy looks strong and it looks like maybe the Fed has a little bit more work to do in terms of remaining restrictive.
Tiffany, what you're reading on sectors of the economy like the housing market, which could potentially suffer a bit more if the Fed, in fact, doesn't cut rates until the middle of the year?
Yeah, so the housing market is a little bit tricky in some sense for the Fed. And the reason is because, after the 2008 financial crisis, obviously we had a housing boom. We had a big levels of inventories of housing as a result of that. But after the great financial crisis, we just stopped building in the United States. And years of underbuilding have resulted in actually a housing shortage, specifically an affordable housing shortage, which we're dealing with today. And the problem with Fed policy, or the kind of conundrum with Fed policy, is that when you raise rates, real investment, real residential investment, so the supply of housing, you restrict just as much as demand. So, in terms of the longer term housing shortage issue that the U.S. is facing, it's not actually clear that higher interest rates are helping that. And so that could be a little bit of actually an inflationary headwind for the Fed moving forward. Now we do think if rates fall, you will see a pickup in housing activity pretty quickly as a result of that housing shortage. And of course, the Fed, that's not something that the Fed wants either. So housing's a little bit tricky for the Fed right now.
All right, Tiffany Wilding, always great to get your insight. Thanks so much for joining us here this morning. PIMCO's chief economist. Thanks, Tiffany. All right, let's take a look at oil and gold, both on the move this morning. Lots of speculation about what exactly a delayed rate cut is going to mean for these commodity trades. Ines Ferre is standing by at the big board. The closer look at some of the downward pressure that we've seen on prices this morning, Ines.
Yeah, Shauna, and we are seeing downward pressure on WTI and Brent crude futures. I do want to point out the U.S. dollar index. This is at a 3-month high, so this is also causing pressure on commodities which are invoiced in U.S. dollars. So let's take a look at the board where we're seeing WTI down about 0.8%. We're also watching Brent crude that is down about 0.6%. I'm going to pull up a 6-day chart here so you can see the decline that we also saw on Friday as well. You do have those comments over the weekend from Jerome Powell, basically saying that a rate cut in March is unlikely. So that is putting a pressure on commodities, because if you cut rates, then economic activity goes up. And so therefore you would see demand for oil going up. So that's why we're seeing some of the pressure here with crude oil. You also do have the U.S. that is pushing for a truce in Gaza. I also want to note that one analyst is saying that we haven't really seen much of a supply disruption despite what has been going on in the Middle East, because U.S. producers have been outputting a record amount of oil in the market. So we are seeing all of any tensions from the Middle East, what we have seen in the Red Sea, all of that is basically priced into oil right now. And then just following up with gold futures, we are seeing gold that is up about $2,033 per ounce. Analysts are expecting this to maintain above the 2,000 level. But again, the U.S. dollar index going up, also putting pressure on gold as well. Guys.
Inez, excellent coverage there. Thanks so much for tracking this for us. Everyone, we've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Americans are still struggling with sticky inflation as prices remain well above the Fed's 2% target. Now, despite those higher costs, inflationary pressures have been easing just a bit, and it's enough for consumers to feel better about the economy. Consumer sentiment soaring to the highest level that we've seen in about 2.5 years in January. The latest forecast from the National Retail Federation's chief economist is saying that they expect consumer spending in 2024 is going to continue to grow. So how are retailers navigating this challenging environment? We want to bring in Michelle Kelly, CEO of Lilly Pulitzer, joining us now. Brands like Lilly Pulitzer, Tommy Bahama, and Southern Tide are under a parent company, Oxford Industries. Michelle, it's great to have you. Thanks so much for joining us here this morning.
Thank you for having me. Great to be with you.
So let's talk about how challenging this setup is for names like Lilly Pulitzer for your company. How are you navigating this challenging environment right now, trying to obviously preserve your margins, but also make your clothing, make your product affordable enough for consumers?
It's a great question, and you phrased it to really get at the heart of some of our challenges right now. We are optimists at heart. The Lilly Pulitzer brand is really all about creating one's sunshine. That's our brand positioning that we use internally as well as with our customers. And so we really believe in that notion of when life hands you lemons, you're finding a way to squeeze the juice and maybe come up with an entire brand as a side circumstance, which is how the Lilly Pulitzer brand got started 65 years ago. So we are, really focused. We're just focused, I would say, is the way to answer that question. We're focused on, finding ways to create value for our customers, create great experiences for them, beautiful product, and consistent great service, despite some of the cost pressures that we are seeing.
Where have you needed to spend further into specific product categories underneath of the Lilly Pulitzer brand in order to not just retain but attract new customers as well? And how are some of those efforts paying off from what you're seeing right now?
Great question. Thank you. We are really focused on innovation and keeping things fresh. I think for the past almost 4 years now, it's been really hard to anticipate which product categories were going to serve the customer's needs best in her life, because her lifestyle has been changing so much, and ups and downs and inside, outside, things like that. So we have really been focused on innovation for the past, always, but certainly for the past 12 months, we've been finding ways to innovate within all of our categories. We've been focused on, trying to find that balance of how we can address her needs. And we have a higher degree of product newness coming in the next 12 months than we did in the past 12 months. We're very excited about that. And then we also have a few new categories that are really entirely new for our customer that should be exciting. We have expanded into the home and gift area, just knowing how important it is to our customers that they have the perfect gift when they are going to see their family, friends, and loved ones. And of course, the world of her athletic pursuits continues to evolve, and we've got some exciting things coming this year on the pickleball front.
Michelle, when it comes to product innovation that registers with your consumer, how do you balance that in terms of that pricing strategy? Going back to where we started here with the inflationary environment still causing consumers a great deal of stress. How have you at all had to raise your prices, or how are you offsetting some of the higher input costs that you're seeing at your business?
We are, it's in the details. The team is working really hard to, again, keep costs down in other areas of the company and the business that don't touch the customer directly. That helps offset some of the cost pressures we see in the product inputs, like you said. We also are, I think, just again trying to adapt to her lifestyle and make sure that we're offering the products that she is willing to spend on. So it's a little bit more of assortment shifts than necessarily pricing changes in like for like products, but that has been a huge area of focus for us. We have seen this year, despite the overall caution that we've seen and the selectiveness we've seen from the customer, she is excited, not just willing to, but excited to spend money on things that make her feel great. They do have to be really special, really beautiful, knock her socks off or her sandals off in our case. But that is, kind of a forever challenge that we will work on. How do we adapt to what she is spending money on? And we have adapted. We have put a little bit more effort into some of our special occasion pieces. We're really working on finding ways to delight her in that, every day, but in an elevated way in terms of her closet.
When you think about the performance, roughly 50% e-commerce, 1/3 brick and mortar, correct me if I'm wrong, and then you think about some of the wholesale partnerships as well that you have. As we're kind of thinking through where companies are trying to navigate where inventories are moving through, how are you engaging with those wholesale partners who are also trying to figure out where they can right-size the inventory that they're taking on in order to have that move through their own either brick and mortar or online capacities?
Agility has been the name of the game. And it's a great question, top of mind for myself and certainly for other counterparts, anyone in my role. Our wholesale partners are critical to our business. And in a lot of cases, it feels like we're really in the boat together. So we do take a pretty collaborative approach. We're very fortunate that everyone I can think of within our wholesale area, we've been in business together for a long time for the most part. And, I think that lets us have a little bit of a, bend, not break when things get difficult. But there's no question we are all, trying to manage through some similar and parallel challenges.
Michelle Kelly, CEO of Lilly Pulitzer, thanks so much for taking the time here on the day. I'm going to be watching out for that pickleball segment that you mentioned. So I'll keep my eye on the paddles out there for sure. Thank you.
Excellent. See you on the court.
All right, definitely. We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Taylor Swift has no bad blood with the Grammys. Swift breaking the record for most wins in the Album of the Year category this week and announcing a new album coming out in April. So it was as much about what they weren't saying plus what they were saying. And we'll break that down here a little bit more because there were some who were a little bit more adamant to talk about the TikTok, UMG, talk about the history of the Grammys. If it was Jay-Z up on stage who rightly pointed out some of the incorrect labeling of some artists in categories. He himself winning the Dr. Dre Global Impact Award. And at the end of the day, putting some attention back on the fact that, hey, his wife, Beyonce, has been mislabeled in categories before and has still had this record of the most Grammys won. And so at the end of the day, there is some larger questions that still swirl around this entire music industry, but none more so perhaps right now than the award selection process itself here right now.
Yeah, the award selection process, that was one of the big takeaways and something that is still being discussed here the morning after, and I'm sure it will be as we look ahead to some of the changes that need to take place within the industry. Also just putting the spotlight on Taylor. Clearly, she has had a lot of focus on her, to say the least, over the last several months, but her influence and how much she is dominating right now the entire industry was on full display last night, not only because of the number of awards that she won, but also the announcement that she made while accepting one of those awards, teasing a new album later this year. And I bring that up because we talk so much about the impact that she has had on a number of publicly traded names, and you got to think, and you got to take a look at Spotify when you think about the potential impact that this new album could have on that business here in the year ahead. Taylor Swift was crowned Spotify's top artist of the year this past year, 26 billion streams worldwide. And this is a stock that has had tremendous amount of momentum to the upside over the past year, with shares up nearly 80%. So if you get a big name like Taylor, a lot of other key albums that are set to be released this year, you would think it would mean at least position some of these names like Spotify pretty well for the remainder of the year.
Yeah, purportedly 25 billion of those 26 billion streams were from a Line producer. One of the huge things as well for this album coming out April 19th, as she so correctly notes as well, is the fact that you're going to see a lot more artists try to figure out, okay, within this music realm where I'm trying to figure out how many plays I get, not just on streaming, how many plays I get on social media, how that gets circulated, how those things go viral as well. She corrects me and says she was her number 2 artist, actually, which only means that the Jonas Brothers were ahead of Taylor Swift this year. But all that these things considered, one huge thing is how much these musicians, these artists now do rely and model some of their own either artistry or how much fanfare they're going to get, and perhaps even tour schedules off of that social virality of a song too.
Yes, especially, and that's so important given this day and age and exactly how so much of this marketing is done on many of these social media platforms. If you're banned, obviously that could have a real impact on sales going forward.
I wish we had a control room camera so that I could at least give her the chance to rebut what I'm saying here.
Well, she's got to join us next time. We're talking Taylor.
We got seats.
We have a resident expert in the house. All right, let's do one quick check of the markets here. 90 minutes into the trading day. You're still looking at red across the board. The Dow off 400, just over 400 points. You've got the Nasdaq off nearly 1% as well. Keep right here on Yahoo Finance. Much more coming up next hour.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo alongside Akiko Fujita. Here's what we're watching this morning. A jam-packed earnings week continues ahead. Over 100 S&P 500 companies reporting earnings this week, according to FactSet. We'll get a check on what's ahead for the markets as Fed Chair Powell tempers expectations further of a rate cut in March.
And keeping an eye on financials, regional banks under pressure after New York Community Bancorp's post-earnings slump. Is this just the beginning of fresh regional bank pressures?
And the IPO market looking to recover this year after a rebound never quite materialized in 2023. We'll dig into 2024 expectations as investors watch out for highly anticipated candidates like Reddit.
First, though, let's do a check of all three majors right now, 90 minutes into the trading day, and we are seeing a bit of a sell-off here to start the trading week. Take a look at where the Dow is right now, down more than 400 points. The S&P 500 down 35, and the Nasdaq down 128. A broad-based sell-off we're watching here, although materials and consumer discretionary stocks taking the biggest hit. But the story of the day, all about bond yields. Take a look at where the Treasury market is right now. All of this in reaction to those comments we got from Fed Chair Jay Powell in that interview with CBS's 60 Minutes here, really quieting any expectation of that rate cut come March. And you take a look at where things are right now. Yields rising across the yield curve here. The 10-year yield up about 14 basis points, 4.17% is where it's trading at right now, and the 30-year yield at 4.35. That is the top story that we are watching today. Surging Treasury yields. We see yields all moving higher as bets on a March rate cut dwindle to just 16%. And, it's interesting to me to see this reaction because in many ways, when you think about what we heard from Jerome Powell yesterday in that 60 Minutes interview, it was a reiteration of what we heard from him at that press conference last week post FOMC decision. The Fed chair making it very clear that he doesn't expect a rate cut come March. But you could argue, Rochelle, there's a bit of a shift in stance, if you will, from the Fed going from defense, really chasing the inflation to try to bring it down back to that 2% level, to maybe playing a little more offense. When you think about what we heard from the Fed chair yesterday, he said essentially, given recent economic strength, we feel like we can approach the question of when to begin to reduce interest rates carefully. They've got a bit of more of a buffer. It's sort of the translation I took away here. And the economic data that we got this morning sort of reiterates that, right? The ISM non-manufacturing index pointing to U.S. services sector coming in hotter than expected. We're talking about 13 straight months of gains now.
And I thought it was interesting that in that 60 Minutes interview, it wasn't so much what Powell said, because he did obviously has been telegraphing that, March was not their base case for a rate cut. But some of the commentary came up in this Goldman Sachs note. They said that during the interview, the interviewer told the audience that Powell suggested to us the likely time for the first interest rate cut would be in the middle of the year and a few months before the election, and that cuts would likely be a quarter, maybe half of a percentage point at a time. So they're seeing this greater chance of a later but steeper path when it comes to these rate cuts that goes beyond May. And so even though Goldman Sachs is still pricing in 5 cuts in 2024, 3 in 2025, the idea that we might not see that until even past March, past May, certainly having some concern here and perhaps contributing to the sell-off that we're seeing as well.
On the flip side, Rochelle, you've got some analysts who've said, look, the market is making too much of the timing of that rate cut. The fact that we are now firmly in position for a rate cut this year, whether that is in March or May or a little later, certainly should lead to cash coming back off from the sidelines back into play here. So, there's a number of debates here about to what extent, we should make of the timing. Bottom line, though, higher for longer is what we're looking at right now in the market. By the way, we did get some commentary from Minneapolis Fed President Neil Kashkari today that sort of kind of points to what we're hearing from the Fed chair as well. In the case of Kashkari, specifically questioning how restrictive the policy in place right now. He did post some commentary this morning saying the implication is that it gives the FOMC time to assess upcoming economic data before starting to lower the federal funds rate, with less risk that too tight policy is going to derail the economic recovery. So March essentially off the table, we think, right? But we'll continue to watch where the market trades on the back of that, because we are seeing yield surge today.
Indeed. And we'll continue to track a lot of that Fed speak that is going to be coming out this week as well. Well, as we've been looking at stocks moving lower as we settle into the first trading day of a week pretty light on economic data. What we lack in data, though, we make up for in earnings. Latest FactSet data shows 104 S&P 500 companies reporting this week. So how will they impact the market's momentum? Joining us now is Kevin Gordon, Charles Schwab Senior Investment Strategist. So Kevin, we've had the week that was with big tech. What are we focusing on now in this week coming up?
Well, I think, as you mentioned with earnings, the focus is probably on a lot of the guidance metrics and what companies are saying about, labor costs, overall input costs. But I think what a lot of the focus is probably going to shift on, at least in on the part of the market, is what the revenue growth story looks like, because you're seeing a lot of earnings estimates being revised higher, but that's not as much coming from the revenue side. It's more coming from the cost side. So companies, aggressively cutting costs, a lot of them recently via layoffs, but you're not really seeing the revenue component kick back in, which I think is fine in and of itself right now. But at this part of the cycle for many companies, which you're going to have to see in terms of, the end of this year and sort of turning into next year, is the estimates for revenue moving higher. So I think that is probably the dynamic worth watching, mostly because if you look at sort of the market's reaction to companies that have missed both on the earnings and the revenue front and have been guiding lower, that's where the bulk of sort of the underperformance has been on the part of the market. So I think the revenue story is probably going to come more into focus this year.
Kevin, so much of the focus last week was on the Magnificent Seven minus NVIDIA here. But to what extent have these results that we've gotten so far this quarter really changed the leadership in the market?
Well, what's interesting about that group in particular is I really think that Magnificent as a descriptor is really in the eye of the beholder. And if you want to just use that only in terms of those companies' size, even that is starting to not work as well as a descriptor, because you have a couple of companies that have now surpassed Tesla. So the mix is getting a little bit murky. And then when you go in terms of performance, I really wouldn't use that descriptor at all for that sort of magnificent word and lumping all of them together, because you've got sort of max dispersion now with NVIDIA and Meta being at the very top of the leaderboard year to date, but Tesla being at the very bottom if you're looking at the S&P 500. So even within that group, let alone the broader market, you are seeing a wider dispersion, lower correlations in, probably a better environment for active stock picking. And I think that's probably more of the story this year, where you're still going to have a lot of churn underneath the surface. And the, maybe the index level gains are still solid, but maybe not as what you were going to see last year, because that cohort is just not moving all together as a monolith anymore right now.
And so, Kevin, when you look at some of the key themes that are going to dominate this week, especially on the heels of what we heard from Fed Chair Powell, do you think the markets are making too much of what they heard from the commentary there? Or do you think they're finally sort of settling in to what the Fed has essentially been telegraphing all along, that it's going to be higher for longer, potentially later and steeper?
Yeah, I think you've got, a digestion phase that has to happen, at least in the short term, just because there had been clearly an expectation on the market's part. And you look at Fed funds futures and what was being priced in for a move in March. I don't think, though, that in and of itself, the Fed just pushing back the timeline to starting the rate cut cycle is, an inherent negative for the stock market. Because, if we get the current set of economic conditions, you just extrapolate that forward with relatively resilient, labor growth, a sub 4% unemployment rate, the inflation trajectory still drifting towards the Fed's target, and then relatively strong and almost reaccelerating economic growth in terms of GDP from here. And if the Fed is just easing a little bit and cutting a few times, they're really actually not easing policy. You're still keeping it in restrictive territory. All of that together as a package means that the economy can withstand higher real rates. And I actually think that that's a fine scenario for risk assets. It doesn't necessarily need to be, sort of that doomsday scenario that those on the more bearish end of the spectrum would predict. I think the rub would come if you had the Fed reacting to, and Powell mentioned this in his press conference last week, the Fed reacting to some unexpected weakness in the labor market, which would then prompt them to go aggressively to rate cuts and, larger rate cuts at that. I think that's the more important dynamic to look at when you're assessing Fed policy this year, is not when they start cutting or how many cuts you get. There's always going to be variability in those estimates, but it's really why they're cutting. So if they're cutting for the so-called right reasons because they can, and they're just cutting a few times to keep real rates in check, again, I think that doesn't necessarily need to be, sort of a pessimistic scenario for risk assets.
So, Kevin, let's pick up on that point. If the timing doesn't necessarily, matter, Is there a bit of an overreaction that's happening in the market right now? Or are we reading too much into it, that this isn't about March, it's about May, waiting longer? How do you
I think the
look at it?
knee-jerk reaction makes sense from a bond yield perspective. As you mentioned this at the opening of the show, the pickup in bond yields that you're seeing, particularly at the long end. I think if you look at the 2-day change in the 10-year, as of now, it's one of the largest moves we've seen going back to mid-2022. So you're kind of getting back into that environment where equities are being spooked by the move up in yields. But at the same time, I think if you sort of zoom out and look at the bigger picture, what has generally happened over the past few months is that this hostile relationship between bond yields going up and stock prices going down has kind of eased a little bit. And we still think for the near term, bond yields are probably in the driver's seat for equities, meaning if they move considerably higher, you're probably going to see more downward pressure on stock prices and then vice versa. But at the same time, if you move into an environment where good economic news is becoming good market news, so to speak, that probably means you're going to get more of a reconnection of bond yields and stock prices, meaning a move higher in yields will be for the so-called right reasons of growth accelerating and it not leading to a move up in inflation. But the caveat there is that you have to get to sort of a sustainable 2% range. And we've made it there in some metrics and what the Fed tracks, but at the same time, you have conflicting data points and cross currents. And again, as you mentioned at the opening of the show, that ISM non-manufacturing survey, the prices paid component, I think the jump there was a bit worrisome. So it's just 1 month. I wouldn't put too much stock into that, but this is really what the Fed has been getting at in terms of wanting to see all the indicators fall into place perfectly to sort of get to their target and hover there for a sustainable period of time. In their eyes, we're just not there yet.
So then, Kevin, when you look at some of the most underpriced risks in the markets versus the opportunities, what are your top in each category?
Well, what's interesting is that you've still got a good chunk of the stock market, whether you want to use the S&P 500 or a broader index like the Russell 3000 to sort of capture the broader market. You've still got a good chunk of stocks that haven't really participated as well in the rally that you've seen, whether it's back to October of last year or even October of 2022. Not saying that they're down, but I think that the optimistic take on the fact that participation has been relatively narrow is that, if we're going back into this sort of normalization of a cycle where key parts of the economy that are cyclically oriented, like manufacturing or like housing, if those catch up and sort of go back into expansion this year, even as services just weakens a bit, that means that everything is starting to normalize again. And I think that that's probably a scenario where the laggards, that have a lot of catching up to do can do just that. So whether it's small caps or whether it's financials or even materials, industrials, again, those cyclical parts of the market that have gotten hit harder over the past couple of years, there's probably more catch up to do there, assuming you don't go into some sort of broad-based recession, and we're not going to feel those long and variable lags from monetary policy that you would normally feel. But that's because of the unique nature of the cycle. So I do think that there are parts of the market that can do some catch up, but at the same time, I think right now that what's going to offset that is still relatively frothy investor sentiment. Whether you look at it in an attitudinal sense or a behavioral sense, if you aggregate all of that, you're still hovering in what we would think of as excessive optimism territory, which in and of itself is not a bearish thing. Doesn't mean that stocks have to turn lower from here, but evidenced by a move like today, anytime you get some sort of negative surprise and catalyst to tip you in the other direction, sentiment tends to accelerate that move downward. But I will say, when you're in an uptrend, these kinds of consolidations, are healthier because stocks don't go up forever. So you need to have something to keep you in check. So I think it would be a relatively healthy scenario and a healthy backdrop if you had these moves in yields kind of keeping the market in check as they continue to trend higher.
Points to complexities of a challenge ahead. Kevin Gordon, Charles Schwab, Senior Investment Strategist. It is good to talk to you today. Appreciate you stopping by.
Thanks so much. Good to see you.
Well, let's take a look at our trending ticker. Shares of ON Semiconductor rising despite reporting a forecast below Wall Street expectations. The chipmaker was in line with expectations in fourth quarter with earnings per share of $1.25 from sales of $2 billion. We're seeing the stock surging, Rochelle, up more than 8%. So much of this points to the expectations game with earnings here, because this was not a stellar report for the semiconductor supplier here. We're talking a year-over-year decline of 3.8% when it comes to revenue as well.
It's true. And when you consider their role, for people who aren't familiar with the company, they make power and sensor chips for automotive and industrial markets as well. And they had been benefiting from this push for electrification and for, some of these sustainable safety grids. But it's also some of these areas that we've also seen a pullback in demand on. So interesting, I think, as you say there, really basing it on expectations, because as you look at the performance over the last year, over the last year, down more than 1%. But so it's, as you can see, it's been a volatile few years, especially for the electrical industry here.
Yeah, outlook also coming in a little lower here. Revenue outlook now at adjusted earnings for the first quarter expected to be at 98 cents versus or to $1.10 a share. So maybe pretty much in line, but not really in the stronger end.
Indeed. I'm seeing the phrase better than feared coming up a lot in these analyst notes. Well, stay with us, though. Coming up, we're checking up on the healthcare sector. Novo Nordisk's parent company acquiring Catalent for $16.5 billion this morning. More on that next. Interest in green energy has gone up overall, but it appears that big oil is lagging behind others in the area. Major oil producers like Exxon and Chevron have been fighting activist investors in the boardrooms and doubling down on fossil fuels with acquisitions since last year. Let's get to Yahoo Finance's Ines Ferre to learn more. Hey, Ines.
Hey, yeah, that's right. On Friday, two impact shareholders dropped their climate proposal after ExxonMobil had filed a lawsuit for that that proposal not to go forth in front of its shareholders, in front of a shareholder vote, with ExxonMobil basically saying that these funds have extreme agendas and that they're diminishing the company's existing business. In a statement follow this, one of the impact funds said, given Exxon's preference to fight a battle in court rather than allow shareholders a freedom of a vote at its annual meeting, we decided to withdraw the climate proposal. Bottom line is that the oil companies have been themselves announcing pledges and initiatives when it comes to green energy, but green activists feel that this isn't enough. And you do have sort of both sides of both shareholders who want more green initiatives, and then you've got shareholders who want companies to scale back on some of their green initiatives and to keep the profits flowing. You'll recall that last year, for example, the two U.S. majors, Chevron and ExxonMobil, reported profits, their second largest profits in 10 years. And that's despite oil coming down about 10% last year. Nevertheless, for example, BP, you had a hedge fund last week which said to BP that it needs to scale back some of its green scale initiatives because BP is it's depressing BP's share price. Now, a BP spokesperson said in a statement that the company continues to receive support for its strategy from shareholders. I also spoke with a senior lecturer from Harvard Business School who wrote a case study on ExxonMobil, basically saying there's no real good answer here because they're trying to sort of go towards both types of shareholders, and there is one that's winning here, according to Mark Kramer from Harvard Business School. He believes that the shareholders who want profits now are sort of winning this battle, as opposed to shareholders that want more green initiatives, which require more capital.
Yeah, it points to bigger challenges ahead for those oil majors. And Esfere, thanks so much for that.
Thank you.
Novo Nordisk's parent company, Novo Holdings, will buy Catalent for $16.5 billion. Catalent is known as a fill-finish company. So that means filling and packaging syringes and injection pens. It will help Novo Nordisk meet demand for weight loss drugs, Ozempic and Wegovy. Let's bring in Megan Fitzgerald, Grey Ghost Advisors, private equity investor, and Columbia University healthcare policy professor. Megan, good to talk to you today. Let's talk about this deal here. I mean, how bullish is that for GLP-1? We've already talked about the momentum there. Is this just a sign of more deals to come?
Yeah, I think what you're talking about is a drug class that could potentially be $100 billion. Recent estimates are putting it at $200 billion. So what we're having here is not a demand problem. We're having a supply problem on the product side. So I think it's a great deal by Novo Holdings to think about vertically integrating so they can have more line of sight and more intimacy in something that has been pretty painful, and that is not being able to meet the supply that patients need in the market.
And Megan, I have to ask you about pricing for some of these GLP-1s, how that's being navigated, given that it is quite cost prohibitive at the moment for your average person, and you have some employers also trying to offer this as well.
Yeah, I mean, for some patients or most, it's about $1,000 a month or $12,000 a year. And some patients have access to coupons. Some patients truly have diabetes, and payers have really been, I think, a little bit more generous to reimburse diabetes, but not so much obesity. There were 9 states that put it on their Medicaid preferred list. And now recently, North Carolina got a $100 million bill last year. It was 10% of the budget, so they've removed it. The Mayo Clinic has now capped out a $20,000 lifetime reimbursement for the products. So the pricing is definitely prohibitive for many patients, but there's still 1 to 5% of the population that is willing to pay the cash and pay $12,000 a year to have access to these medicines. So right now, I think we're seeing a market on the reimbursement side that is largely in flux and unfolding. But right now, it's the folks that can afford it that are really continuing to drive the market and keep the pricing where it is.
And Megan, let's talk healthcare broadly here in terms of the headwinds we're seeing within this space. Higher costs, certainly something that we've heard on these earnings calls already. Medicare Advantage, one of those big drivers of the costs. How much visibility do we have in terms of how much that's already been reflected here? And when you look at the names across the board, who's the most exposed?
I think anyone with a heavy book in Medicare Advantage on the payer side has more risk and exposure, especially for the near term in 2024. You have pent-up demand from patients from COVID, and Medicare Advantage is a very rich and positive program for a senior if they have it. So you're seeing an increased demand in expensive medical care that is really hitting some of the payers. And we saw recently with Cigna, they had less exposure to Medicare Advantage, so they navigated this a little bit better. So I think we're still seeing headwinds in terms of inflation, labor shortages, provider margin pressure, and like I just said, those with Medicare Advantage seem to have been hit a little bit harder, and that's going to take a little bit of time to work its way through the system.
And Megan, we've been watching Big Pharma sort of adapt sort of post-COVID, at least, but post-peak COVID, and really looking at the what's next story. And you look at some of these 4 big chronic diseases that you lay out that we could be seeing more investment in: heart disease, cancer, neurodegenerative diseases, and type 2 diabetes. How are we seeing inflows into those investments, and who do you think is best positioned?
I think all the big pharmas have indicated, Roche and Merck. Merck said, hey, we're willing to look at $15 billion deals. Everyone's looking at tuck-ins. I think where there is an economic value proposition and high clinical rigor, we're going to continue to see biopharma do tuck-in acquisitions, and will continue to be very active. So I think they all sit quite well. Even Bristol Myers said they're willing to do a bolt-on acquisition. So I expect biopharma will, especially the larger players, will continue to be quite active. And we saw this at JP Morgan. Everybody was out hunting for rare diseases, immunotherapy, oncology, cardiovascular, all the areas that you mentioned. It's also why the GLPs are also interested in maybe showing their value prop in cardiovascular disease as well.
And just to follow, I want to ask you, because we talk about neurodegenerative diseases, about Neuralink. Obviously, still very early days with the very first patient here, but what sort of landscape are we looking at? Being that we've seen this in sort of the university sphere in testing, but what could we be looking at commercially here?
Yeah, I think it's very interesting. It's one patient. It's very early. I'd imagine all the focus right now is on safety because you are talking about the brain. So we're going to be super concerned looking at, if there's going to be any brain bleeds, any infection. But brain-computer interface, which is the technology that Neuralink is powered by, has been around for a while. It records and decodes the brain. And the thinking is it could really help people with severe paralysis be able to, with thought, command a robotic arm or help them with the computer. So I think it's super exciting in terms of area of research and interest. But again, it's one patient. We don't have the protocol. It is, a protocol that was obviously approved by the FDA, but the trial has not been uploaded to clinicaltrials.org, whereas where folks like us like to dig in to see what the protocol is and what the indication is. So I think very early, but obviously very exciting because of the potential impact in the patient population it's looking at.
Indeed, we'll be looking forward to seeing how that progresses. Appreciate you taking the time to join us this morning. Megan Fitzgerald, Grey Ghost Advisors private equity investor and Columbia University healthcare policy professor. Thank you so much. All right, coming up, regional banks facing a sell-off. Are we headed towards another crisis? We'll have more next.
We looked at the larger banks' balance sheets, and it appears to be a manageable problem. There's some smaller and regional banks that have concentrated exposures in these areas that are challenged, and we're working with them. Certainly, there will be some banks that have to be closed or merged out of existence because of this. That'll be smaller banks.
That was Fed Chair Jerome Powell speaking on 60 Minutes about the risks stemming from the commercial real estate sector. Well, regional banks are under pressure again today after a sell-off at New York Community Bank reignited fears of an impending crisis. This comes after the bank reported net loss charge-offs that were 10 times larger than analysts' expectations. For more on the state of the commercial real estate sector, let's bring in Elon Braca, IB Global Real Estate Fund founder and CEO. Elon, there was another story, of course, Japan's Aozora Bank last week downgrading their outlook on the back of their exposure into U.S. commercial real estate. Let me just first get your reaction to what the Fed chair said there. Do you agree that the risks are manageable when it comes to commercial real estate?
So, yeah, first, thank you for having me. And yes, absolutely. It looks like we are in a better part of the process. If we manage to get to 2024, we should thrive in 2025. So we are in a spot that's everybody's looking for a cut of the rate. Everybody look on the sideline, and the perception on the street is so important. And all the correction that you see, it's something that's been escalate because of the pandemic. So stuff that should happen just escalate in a much higher speed. And we are dealing with over $1 trillion of loans. And that's the biggest situation. The amount of the loan that's out there, that's what's the biggest impact we feel it on the street today.
And so, Elon, what are the most likely scenarios you see developing from here?
So obviously, if they cut the rates, would be more confidence on the street, and we can work it out. They're going to work it out, the situation with the existing borrower. But the one thing that I will focus on is the level of management that took those loans, the level of management that's handling those buildings. The building situation of the commercial changed from the needs of it for many, many other reasons that I just mentioned. But it's the management team, it's so important. And the banks working with those big lenders, big loaners. And I think this will impact the results, definitely.
What do you mean specifically about the management? What needs to happen here to impact those results you just talked about?
Those buildings, those big buildings that took those majority of those big loans need to be handled smart. And we talk about, most of them were in New York City, in the New York metropolitan. Those are big buildings that need to change the way they operate. So the A-class building, I don't see any problem. They don't have a problem even now. I think the B-class building is one of the biggest problem. With the right management, either the converting, either working out with the lender, and buy time until the interest will go down, or eventually that's what it looks like, or they're talking about, while waiting. So if we buy the time right, they will be able to refinance, they will be able to get to a better position with their buildings and get, tenants coming in. Even if the tenant unit mix change, even if the tenants needs change, with the right management, they will work it out and prevail.
So then, as you look at the potential winners and losers here, as a lot of these buildings are coming up for refinance, a lot of these loans as well. What are the standouts for you? What are some of the companies that you're looking at?
So we basically looking at all the conversions opportunity that you have over there. Because the residential market, if we touch for a second, the residential market in New York City, it's down by 40% on volume. Now, if you manage, not all of the building you can do it, but if you can take the B-class building or the C-class building and you can do a new development or conversion to residential, I think this is the opportunity that will allow, to bring back the value and make even a profit. And change the whole cycle here. So you can do it on all of them. You can do it in specific location, but there is an opportunity with the situation that we have now, and that's really the focus on the right management and the banks working with those guys. That's the way I'm looking at it.
We'll certainly be looking out to see how some of these companies capitalize on these opportunities. Appreciate you taking the time to join us. Ilan Braca, IB Global Real Estate Fund founder and CEO. Thank you so much.
Thank you. Thank you for having me.
All right, what a way to mark a 10-year anniversary as CEO. When Microsoft, Satya Nadella started his role at Microsoft, the stock was around $30, now sitting at over $400. And of course, surpassing Apple as the most valuable company thanks to its early lead with generative AI. And Akika, when you think of what's happened under his tenure here, I mean, including things like supercharging their intelligent cloud business to generate almost $90 billion in the last fiscal year, it really was something that a lot of us couldn't have predicted. I'm sure if you gave a lot of people $1,000 10 years ago and they had to pick between Microsoft and, say, Apple, their bet probably would have been on Apple. But then, of course, enter, their supercharging of the cloud and, of course, generative AI as well.
Yeah, it's worth going back to 2014, Rochelle, because Satya Nadella followed Steve Ballmer, who you could argue was a much flashier CEO. And there are questions about who Satya Nadella was, whether in fact he could take this company and really supercharge it, as you've said. $300 billion is what the market cap was when he took over. Today, we're talking about a $3 trillion company. And he doubled down on the cloud, right, to start with. And you had plenty of analysts who said, well, that's not necessarily the right focus. But today we're talking about a leader in cloud, in artificial intelligence, all under Satya Nadella's watch. Also been interesting to see some of the acquisition strategy here under his tenure. LinkedIn, Activision, Blizzard, the two big ones, but there's certainly been many more. And look, Microsoft, at least right now, the most valuable company, looking at a $3 trillion market cap. So been a certainly very productive 10 years for Satya Nadella.
I mean, when you think of the legacy he's going to leave by especially getting out in front with OpenAI and generative AI here, I mean, he certainly left his mark here. I would consider his iPhone moment. It's a game changer.
Yeah, and it all started with him focusing on the cloud first, right? I mean, that sort of really changed the trajectory for Microsoft. But again, focusing on this because Satya Nadella just marked 10 years as CEO of Microsoft. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Apple's new mixed reality headset, the Vision Pro, hit the market February 2nd. The company's first new product category in nearly a decade, the Vision Pro kicks off a new era of computing for Apple. But a hefty price tag, coupled with the fact that the AR/VR space is still an unproven market, mean that Apple is fighting an uphill battle out of the gate. Here are 3 things you need to know about the Vision Pro. Number 1, the price tag. The Vision Pro starts at $3,499. That's far more expensive than rival Meta's priciest headset, the Meta Quest Pro, which costs $999. That price will likely prove to be too rich for even Apple's most ardent fans, especially given the AR and VR industry's relatively niche position in the consumer tech space. Apple is advertising the Vision Pro as a spatial computer rather than a simple headset. You'll use it for watching movies, playing games, and importantly, productivity apps, since it can mirror your MacBook's screen and display it as a massive window floating in space directly in front of you. Whether that's worth the price of entry is up to Apple's legion of customers. Number 2, the experience. I used Apple's Vision Pro headset immediately after the company debuted it at WWDC in June 2023, and again just ahead of its launch, and everything you've heard about it being a mind-blowing experience is spot on. The incredibly high-resolution micro OLED display is worlds sharper than any other headset I've used, making images and videos appear crisp and colorful, and ensuring you can easily read text. The interface is wildly easy to navigate thanks to eye and hand tracking cameras, and the fit is surprisingly comfortable, though there is a separate corded battery that you'll need to put on your desk or slide into your pocket. Of course, Apple also needs to ensure it has the app ecosystem to match. So far, the company says it has a vast library of apps, including versions of its iPad apps. But the tech giant will also need developers to dream up apps uniquely designed for the Vision Pro if Apple is going to get people to stick around past the honeymoon phase. Number 3, what does this mean for Apple? The Vision Pro is Apple's first new product category since it first unveiled the Apple Watch in 2014. And while the watch landed at a time when smartwatches and fitness trackers were already gaining steam among consumers, the Vision Pro comes at a time when headsets still make up an incredibly small number of consumer tech sales. Apple is also going up against Meta's Quest line of products, which Counterpoint Research says made up 49% of the AR/VR headset market in Q3 2023. If Apple can get consumers to look beyond the Vision Pro's price and convince its army of developers to build new fascinating apps for the headset, it could be the company's next smash hit. Stay tuned to Yahoo Finance to see if Apple can pull it off.
The IPO market is looking to regain its momentum after rate hikes, bank failures, and geopolitical tensions placing pressure on prospective issuers, with several highly anticipated public offerings expected this year, including Reddit and Rubrik. We're checking in on the path ahead for the IPO market. Let's bring in Matthew Kennedy, Renaissance Capital Senior Strategist to discuss. Good to talk to you today. Let's start with Reddit here, because this is an IPO that has been 3 years in the making, at least when you consider the delays. The fact that they are likely to come to market finally, what does that tell you about where the appetite is in the market right now, especially around tech IPOs?
Right. So as you know, the market has been dormant for 2 years, but I think as Reddit shows us, the stars are aligning for a solid pickup in 2024 and 2025. We've already had a good start to the year in terms of activity, but we do expect to see that number rise towards the end of the quarter and heading into the more active summer months. And that includes Reddit. I think the demand is there for companies that can offer strong growth and an inflection point on profitability. And I think that's what Reddit will pitch.
So Matthew, just to take a step back then, give us your base case as to why you think it's actually the IPO appetite is going to pick up in 2024.
Right. So first and foremost, last year we saw a strong recovery in our IPO index. That's tracked by our IPO ETF, ticker IPO. In addition, the S&P 500 hit an all-time high. Investors are willing to put money back to work. On the company side, that means higher valuations in public markets than any point since 2021. More and more VC-backed tech IPOs can avoid down rounds. Tech unicorns have spent 2 years getting to profitability. Many are at that inflection point. And these past 2 years have built up a bottleneck of companies. That pipeline of IPOs has grown and grown. More companies want to go public. We've seen IPO filings reflect that. Public filings, confidential filings, pockets of activity from biotech, insurance, fintech, healthcare. So the interest rate environment is another area. There's a lot of reasons why we are expecting 2024 to be a big market. Interest rates are maybe a little bit of uncertainty there, but at least we're not rising. That's definitely a positive.
And Matthew, how much of this also has to do with what's been playing out in the VC space and the private funding side of things? You mentioned the down rounds that we saw. Instacart came public last year, but it was one of those companies that saw a down round prior to listing. Is the reality here that it's better to come to the public markets because the funding on the private side isn't as abundant right now?
Absolutely. There was basically no harm in staying private for as long as possible back in 2021 when private markets were so generous. That is not the case anymore. So for companies that need capital, the public markets are certainly looking a lot more attractive right now. I think there's other reasons companies are starting to look to go public in 2024 as well. I wouldn't think that it's only that reason. I think fundamentals is probably a strong one for Reddit. I think that they probably had a very decent 2023. They can probably point to improving trends. So that means growth and profitability. CEO did say that he expects to achieve break even in 2024. So that's very important. They've probably built out their ad platform. Maybe some advertisers have shifted money from X to Reddit. Maybe they'll highlight their data as a play on AI. Maybe they'll get, ad dollars ahead of the 2024 US election. So I think there's a lot of reasons why they're choosing to go public right now. Also pure trading. I mean, if you look at Snap, Pinterest, you saw what happened with Meta at an all-time high. So, they could continue to wait for a perfect market, but there's a lot of green lights right now that just point to a better market than anything they've seen in the last 2 years. And like you said, they have been waiting a while.
And Matthew, I have to ask you about Shein. Could potentially be one of the biggest IPOs that we see this year. What are the chances of this coming to fruition? And what are some of the things that you're going to be watching in terms of headwinds, especially as obviously it's still some scrutiny for some of these companies based in China?
Right. So Shein is one of those companies that had been at the top of our list for most anticipated IPOs of 2024. In terms of its valuation, I think that had been a big driving factor, what people are expecting. But it seems like the headlines have just been one negative after the next, whether it's coming from US regulators or Chinese regulators, concerns about the environment. So they'll have to overcome those various negatives and headwinds and convince investors. I'm not saying they can't do it. I think that like any company, if you pitch a clear and compelling story and an attractive valuation, that'll get some eyeballs. But yeah, they do have an uphill climb based on what we've seen. Especially since there are other IPO candidates out there too.
Matthew Kennedy from Renaissance Capital, it's good to talk to you today. Really appreciate the time.
Thank you.
Coming up, a slew of earnings reports set for this week. We're going to break down what to expect from Spotify. That's coming up next.
Investors are shifting focus to Spotify this week, with the company set to report results before the bell tomorrow. Yahoo Finance's Alexandra Canal is here with what to expect, and especially with Grammys euphoria still in the air.
Music definitely still in the air, Rochelle, and we'll hear from Spotify bright and early tomorrow morning. The audio streaming giant is expected to post revenue of $4 billion on an adjusted loss of 33 cents a share. But it's going to be the margin story that investors will be really focused on, especially when it comes to that margin expansion, which just recently turned a corner. Margins expected to come in at 26.6% in Q4. That's according to the company's own guidance, and would be a slight uptick compared to what we saw in Q3. We've really seen margins stuck in that 24 to 25% range amid those heavy podcast investments. But with recent price hikes, layoffs, lower marketing and personnel costs, those margins should continue to improve and add to that profitability story. Now, I mentioned podcasts, and I do think that's going to be a big conversation point during the earnings call. We just got word that Spotify renegotiated a deal with Joe Rogan, along with Call Her Daddy's Alexandra Cooper. Both of those deals will see Spotify distribute those podcasts across other platforms rather than the company retaining that exclusivity, which is a big pivot compared to what we've seen. Spotify spent around $1 billion really pushing into the podcast market. They committed to these big splashy A-list deals, but this recent pivot from exclusive to a distributor really points to the fact that they want to get more eyeballs, more people listening to those podcasts at the end of the day, and that's going to drive those ad sales, which again expands those margins and profitability. And that brings me to my final point I want to mention, which is subscribers. Spotify expects premium subs to increase by 9 million in the quarter, with 27 million new monthly active users expected. And this is something that Spotify has consistently delivered on. We haven't yet reached that point of subscriber saturation, which is great, especially when you think about all of the competitors on the market right now. So Wall Street overall seems to be pretty bullish on this efficiency story that's evident in the stock price. We see shares up nearly 20% year to date, up more than 80% over the past year. And if you think about where we were even at the end of 2022, this is a pretty impressive growth story. So we'll see if tomorrow morning Spotify can deliver on those targets, and we'll see what the stock reaction might be as well.
Indeed, we'll be digging into that.
And we'll, of course, be turning
earnings
to you for those results.
Thank you.
All right, well, let's get your final check of the markets as we head into the noon hour. Still looking at red across the board here, bouncing around those session lows, seeing the Dow here currently off about 350 points, or just about 1% on the day. Looking at the S&P 500, also down about 0.5%, and the tech-heavy Nasdaq as well, also down about 0.5% as well. Stocks continuing to fall as the Fed continues to throw some cold water on those March rate cut hopes, pushing back perhaps steeper as well as higher for longer in the end of the year. All right, well, that does it for us. I'm Rochelle Akufo alongside Akiko Fujita. Stay with us on Yahoo Finance.